Welcome to the afternoon session of the JC3 Finance for Change Flagship Conference, hosted by Bank Negara Malaysia and Securities Commission Malaysia. JC3, or Joint Committee for Climate Change, was formed in 2019, co-chaired by Bank Negara and Securities Commission Malaysia, with members comprising senior officials from Bursa Malaysia and 19 industry players. The JC3 is set up to pursue collaborative actions for building climate resilience within the Malaysia financial sector. So we're having this conference over 3 days. This event is supported by the UK government's ASEAN Low Carbon Energy Prosperity Programme in partnership with Ernst & Young. And this conference would not be possible without the support and hard work from CIMB, SME Bank, and Zurich, and without the help from our knowledge partners, Climate Governance Malaysia, WWF, FIDE Forum, Swiss Re, Fair Finance Asia, AFI, and IBFIM. Believe me, I have witnessed firsthand the level of efforts, the sweat and the tears that have gone up into the preparation, and I hope you will enjoy the results over the next 3 days. My name is Gilles Pascual. I'm a partner at EY, where I look after renewable energy and sustainable finance in Southeast Asia. I'm also the program director for the UK government's Low Carbon Energy Prosperity Programme, and I will be your MC for this afternoon session. Before we kick off, some housekeeping announcements. Please note that the conference will be recorded. Replays will be available on the IBFIM website. Microphones for the audience are disabled, but please submit your questions, your comments via the chat functions. Your active participation is highly encouraged. I will be monitoring the chat functions, and I will be asking and relaying your questions to the speakers that will join us this afternoon. We will be conducting polls throughout the session, so please stay engaged and participate as much as possible. We highly encourage you to join from either a laptop or a desktop in order to access easily the polling questions, the chat functions. It's a lot easier than if you're joining on your phone. And to ensure a smooth experience technically, please close as many applications running in the background and use WebEx only. If you are facing any technical difficulties, please drop a message in the WebEx chat to the host, and he will get back to you as soon as possible. All right, so we have an exciting lineup for the afternoon, and you can see the agenda. We will have, so perhaps before I get into the afternoon sessions, just to summarize the morning, I hope you enjoy the very inspiring video shared by naturalist Sir David Attenborough, the message from the governor of Bank Negara, Malaysia, setting the scene for the event, as well as the discussions with the UK Regional COP26 Ambassador for Asia Pacific. Then we had 3 panel sessions covering why and how to begin your sustainability journey at an institutional level, whether you're representing a bank, an insurance, an investor, or others. This afternoon, we've split ourselves into a number of sessions. So you are in the institutional banking session. In parallel, we have sessions for consumer banking, asset managers, insurance, and Takaful, as well as ancillary services. So we will hear from Standard Chartered, BNP Paribas, and EY on the topics related to ESG and opportunities at a transaction level. Our first session for the afternoon will be a presentation entitled Examining the Past and Visualizing the Future, delivered by my colleagues from EY, Russell Marsh, who's the Green Finance Lead of the UK government's ASEAN Low Carbon Energy Programme, and Arina, who's a partner in Climate Change and Sustainability Services at EY Malaysia. And they will be joined in their presentation by Suzanne Biegel, the founder of Catalyst at Large, and an expert in gender smart investing, who will provide insight on how genders relates to climate, and how do we integrate gender into climate consideration. So this presentation sets the context for the focused afternoon, talking about general sustainability risks and impact to the financial services sector, the need to adapt business model to sustainability, sustainable finance opportunities, and aligning and setting 2030 sustainability commitments, amongst other things. This is a common session that's delivered across the 5 breakout rooms that are running this afternoon. So we had pre-recorded this session 2 days ago, and it ensures that every breakout room will get the same content and experience. I will be collating and monitoring the chat function. So again, please send your questions, and I will cover this at the end of the session. So Arina, Russell, and Suzanne, over to you, please, for the first afternoon session.
Hi, good afternoon, everybody, and welcome to this afternoon's session called Examining the Past, Visualizing the Future. My name is Russell Marsh, and alongside my colleagues Arina and Suzanne, I will be presenting for you this afternoon. So firstly, the 3 speakers you hear from this afternoon are myself, Russell Marsh, and I'm a director at EY based in Singapore. My colleague Arina Koch, who's a director at Ernst & Young in Malaysia, and Suzanne Biegel, who's a founder from Catalyst at Large and a co-founder of Gender Smart Investing. So today we'll be covering an overview of the general sustainability risks and what that means in terms of impact on the financial services sector, how business models need to adapt to reflect that sustainability, and particularly looking at opportunities for sustainable finance, aligning sustainable finance to national 2030 commitments, looking at how you integrate governance and management in terms of looking at sustainability, looking at enablers for sustainability change agents, and then finally, gender and climate investment. So firstly, and I'm the biggest part of the session this afternoon, just looking at what are sustainability risks and how do they impact on the financial services sector. So firstly, what we're seeing is a range of activities that are creating pressure on businesses to increase their focus on sustainability and ESG. And I think it's pretty clear now that sustainability and ESG is no longer an option, but it's a necessity if businesses want to stay relevant. On this slide, I just outline a number of those pressures that are changing and coming to businesses, in particular the financial sector, and why they need to start really taking into account ESG and sustainability. And that's both in terms of the first one on that slide, in terms of the science, in terms of changing with the warming world, so particularly in relation to climate change. That's leading to increasing prominence and focus on the global agreements for climate change and getting countries to take on increasingly tighter targets for emission reduction. You've then got national governments increasing their regulations around how financial institutions and corporates more broadly should take into account a focus on climate change in particular, but broader ESG. They've now got an increasing demand for non-financial information from investors, all looking to understand the ESG impacts of their investments and asking those companies that they invest in to provide much more non-financial information and much more ESG investment and data as part of their decision-making processes. And we're seeing consumer behaviour changing. So consumers are starting to demand more products that provide a more positive impact on the environment and more sustainable products. And so we're demanding that through their purchasing that they're starting to look at these, adapting to and buying these kind of products. So looking particularly right now, we're obviously in the middle of and kind of hopefully coming out of the COVID-19 pandemic, but the onset of the pandemic and its increased focus on climate change has really highlighted the importance of ESG in investment decisions. And looking at the stats on this slide, what it's showing is how investors are viewing a number of these ESG issues. It's clear that majority of investors are really starting now to look at a whole range of ESG issues, whether that's climate risk and natural resources, whether it's gender diversity, whether it's evaluating companies' non-financial performance. So there's a range of different factors that investors are now looking at when they start looking at their operations. And you can see that that has grown over the last couple of years in terms of that slide on the left, or the left of that slide, showing the percentage of respondents in the survey, how they looked at things like environmental, social and governance risk, and that's dramatically increased from 2018 until 2020. And taking that a little bit further, we've now seen that the top identified global risks have shifted very much now towards focused on environmental, social, and ahead of economic factors. And this is a study that was done by the World Economic Forum, that's looking at this global risk report. So if you look at the difference between the top 5 risks on the left and the top 5 risks on the right, it just shows how now extreme weather, climate change, natural disasters are much higher risk than some of the economic risks that were at the top of the list in 2010. So that's just a clear indication of how global risks are being looked at and how climate change in particular is now seen as a significant risk. And looking at that in a different way, this is another similar graph from that report from the World Economic Forum in terms of global risks. They're showing that the climate action failure is identified as the risk that has the greatest impact and is the second most likely long-term risk that's been identified. What we've seen, in terms of the global pandemic, we've seen what happens if you ignore long-term risks of things such as pandemics. And obviously the goal now with the pandemic is to reduce harm while waiting for a vaccine. However, there is no vaccine for climate change, so we need to take action on climate change very differently to how we're dealing with the pandemic. And the other thing to recognise, obviously, is that economic activity has bounced back after the financial crisis, and that's starting to see emissions increasing. And so we're going to look at how we can grow the economies, but as we emerge from the pandemic, but without having that similar impact on global climate change emissions. Also seeing climate change impacts are now emerging much more quickly than anticipated. And on the left, just highlights a number of the measures and impacts of climate change. And it's showing that we're starting to see all of those increasing much faster than had previously been seen, whether that's ocean heating, sea levels rising, or the Greenland ice cap melting. And that's leading to things like greater income inequality, higher food insecurity, and increased urbanisation as people have to move away from areas that are going to be subject to coastal flooding in particular. So then looking at, what does that mean? So how does climate change, how do those natural impacts of climate change end up becoming a source of economic and financial risk? And what this slide does is look to just summarise that at a reasonably high level. And what we talk about is two things. We talk about physical risk and we talk about transition risk. So the physical risk is the risk by an actual natural disaster event, so like an extreme weather event, what that actually can, the impact that can have on the financial sector, again, in terms of having to build back that infrastructure that's destroyed, that's a definite risk and a physical risk on the financial sector. And then you've got transition risk, and this is the risk to corporates about having stranded assets or this move towards a lower carbon economy. So an increase in policy and regulation from governments, emerging technologies that take over because they are low carbon taken up by the market, and general market sentiment. Again, we talked earlier about how you're starting to see a number of drivers on companies to move towards incorporating ESG considerations within their operations. And if companies don't respond to that, so they can end up, say, having a big financial impact as the products they provide are no longer wanted by the market, or to say the products they produce are impacted by changes in policy and regulation. If you're thinking particularly about the energy sector, obviously, as governments increase their focus on reducing carbon emissions from the energy sector, if you've got a high carbon intensive energy sector, that can be a big risk in terms of the speed at which some countries are taking that transition to a lower carbon energy sector. And looking at that a slightly different way, this takes us a little bit further. This is, okay, how do we see those climate change effects come through in terms of the economy and financial stability. And looks at, say, both again from the physical risk drivers and the transition risk drivers. Where you see, as a result of physical risk, you see this business disruption, you might see capital scrapping. And that will lead to potentially lower property values, lower household wealth, and that can have a link through to the financial system in terms of financial market losses, credit market losses, etc. And then similarly on the transition risk, where you're seeing changes in climate policy, change in technology, change in consumer preferences, you potentially have stranded assets in terms of fossil fuel generation technologies, some real estate infrastructure, etc. And that can lead to corporate asset devaluation, low corporate profitability, etc. And then have lead to financial market losses. And then there's obviously feedback loops within that in terms of the financial contagion through market losses and credit tightening, feeding back to the economy. So what you've seen there is at a relatively high level how, in particular, climate change can have a direct impact on the financial system and a direct impact on the economy, and therefore, how businesses broadly and financial sector in particular start thinking about how can it adapt its business models to respond to that challenge, and in particular also thinking about the opportunities. So what this does is look at, again, how does sustainable finance, what does sustainable finance mean for the full business model of an institution? And what this slide looks to do is try and look across the whole of the operations of a business, what's their role, what's the impact of this continued focus on ESG and sustainability and sustainable finance on that company. And that's everything from so you've got the business implications and challenges on the left. You're going to, in terms of shareholders, you've got changed shareholder goals. We're starting to see increasing shareholder activism, where you've got shareholders who are looking to really change the internal process of the company and get it to take on higher targets, particularly for climate change emissions, through using its ability as a shareholder. You're starting to see new investment products coming out into the market. You've got new terminology, new regulatory requirements you need to understand, and how you can embed those within your risk management system. You're going to have new and changed risks. So risks that you're facing now, the risks you might face under some of the scenarios for climate change could be quite different. So you need to understand how those risks are changed and how that fits within the company. You may start to see changed policyholder behaviour, changed employee behaviour. Again, employees looking to see their company do more in some of these areas. So how do you respond to how employees are starting to view these issues? Your business partner behaviour. Again, working with a lot of businesses. What are they doing? How are they changing their behaviour? How are they responding to these demands? But I think also looking at product innovation is not all risk. It's also looking at these new market opportunities. Particularly look around in terms of energy transition, moving towards a lower carbon economy. The amount of investment, the amount of new technology we're going to need to meet some of those targets is huge, and that's where there's a real opportunity for companies to start looking at where they are now and where the opportunities are in the future, and how they can start to move towards embracing and taking the benefit of those new opportunities. And this looks at this a slightly different way in terms of looking across different parts of how this transition, these strategies for sustainability works across different parts of the organisation. So you've got products. So we know, again, and talked about consumers continuing to demand more ethical and sustainable practices and products, and again being able to have products that meet that need. Within internal operations, again, how can you make sure that your internal operations are becoming more inclusive and environmentally friendly, and having those internal policies that help drive those activities? So impact investing, where FIs are now looking to invest in projects, companies or organisations that have some positive social and or environmental impact. So looking explicitly to seek out those opportunities to only invest in technologies and companies that provide a specific environmental impact, whether that's renewable energy, social housing, as some examples. Looking at distribution, again, how can you adopt sustainable ways of distributing services? So there's this US bank with its in-app voice assistant, so it provides better accessibility the banking services. And again, just to see how the distribution of these services is changing to meet the needs of retail customers in particular. Collaboration, collaboration seen particularly in the sustainability space. We're starting to see a number of external partnerships between financial institutions to help increase and offer this wide range of integrated ESG solutions. The example put up here is about BNP Paribas collaborating with Greenly to offer some carbon tracking to its consumers through their banking app. And that's just an example of how collaborating externally can help drive a new product and innovation that this particular institution wanted to deliver. And then policy, again, how you're integrating and incorporating ESG into operations. And a number of banks and financial institutions and others are signing up to various frameworks and strategies to help align their operations alongside related ESG-related causes. I think it's fair to say now that financial institutions need to do more to overcome the barriers and reap the benefits that ESG provides. And this slide looks to look at some of those. So this integration of ESG into risk management services, so really having ESG criteria integrated as part of their already risk management frameworks to help move their capital flows towards more sustainable investments. Looking at addressing gender diversity just beyond equitable workplace ethics. So looking at how you extend some of these frameworks around gender diversity down the supply chain and to customers as well. Common taxonomy, this is often the most difficult one in terms of, again, how do you define what we talk about when we mean sustainable? And sustainable practices and sustainability means many things to many different people. So have an agreement about what is a common taxonomy, what do we mean when we talk about sustainability is really helpful. And also useful to see that there's work going on within Malaysia to help try and develop some sense of what that definition looks like within the Malaysian market. Again, common standards for ESG disclosures. There's a range of different standards out there. And again, having this convergence and global guidance on sustainability standards will make it easier both for the industry to adopt those standards, but also then for the external stakeholders to be able to follow and understand what it is that companies are doing. And then elimination of greenwashing, and this comes up quite a lot in terms of being really clear that what you're doing and what you're promising to you are doing, and the consumers and others can have real confidence in that again the ESG claims you're making are actually backed up by what you're doing. And this is just one example, and I won't bear on this too much, as you can look at the slides in your own time. This is just an example of where Barclays, a bank, is focusing on products, distribution, impact investment and policy for its sustainable growth. So how it's looking across all of those issues, both, and a couple of examples we put on the slide in terms of looking at green home mortgages, looking at sustainable investing solutions. It's looked at financial inclusion for the disabled. It's looked at how it works with some financially vulnerable consumers, and it's had an impact eligibility framework, providing clear social, environmental and inclusion criteria to track and categorize financing volume, so including labeling green and social transactions. Again, that's just an example of how this particular financial institution is looking across all of those different criteria to look at how it can become a more sustainable company and has more sustainable growth. So I'm now going to hand over to my colleague Arina to take us through the next few sections of this afternoon's presentation. So thank you very much for the moment.
Thank you, Russell. And I'm going to kickstart with the next part. What we're going to do for this next session is really to discuss about how, essentially the finance for change can actually drive or rally, direction from all sources, as well as how does it align not just from a national 2030 commitments, how do organizations like financial institutions can drive this, and down to the granular detail of what each enablers or business unit can do. Now, looking at the next slide, when we look at what Malaysia has been focusing on, we do have a commitment to achieve the 2030 Agenda for Sustainable Development that addresses the key mega trends. So in 2021, the United Nations Sustainable Development Cooperation Framework 2021 to 2025, the UN SDCF, constitutes how the UN development system could support Malaysia's strong commitment to achieve the agenda. And it's really very much focused on the aspiration for Malaysia to become a high-income, inclusive, environmentally sustainable, and advanced democratic nation. And what this framework helps is to support, effectively collective system support for the country to address where are the bottlenecks, the trade-offs, the synergies towards the journey, and essentially to also provide the United Nations system support to strengthen the whole of nation approach to achieving these SDGs. And when we look at the diagram here, these are the 6 focus areas, as you can see, and how it's aligned to the 17 SDGs. Now, I just want to highlight that these are the key material issues where we have to actually have a targeted fit for purpose solutions that actually can drive multiple benefits on these areas. So when we look at the population growth and demographic change, there will be certain strategic areas that can also be addressed by the likes of digitalization, how this can actually drive certain microfinance, whether the digital banking can actually drive some solutions towards the new world order, and what are the pressure on the ecosystem in terms of the health requirements, as well as the food security discussions. What are the societal changes and changing face of the customer? When we look at infrastructures are being reconstructed, and we looked at to consider the drive of EV infrastructure, or the likes of upgrading in terms of not just on renewable energy, but consideration of storage and CCUS. These are the mega projects of technological innovation that will come into play. Of course, the key question now is how does finance as well as the larger ecosystem bring this change? So looking at where the funding gaps are essentially focused on, when we look at the statistics that has been put out in place, so according to the UN conference on the trade and development World Investment Report, between $3.3 to 4.5 trillion needs to be mobilized annually to achieve the 2030 Agenda for Sustainable Development. Now, this essentially highlights the funding gap for investment, and this is where the opportunities lies in for not just the public, but also the private sector, especially for developing countries, which is estimated at $2.5 trillion. Now, the graph essentially outlines the 2.5 million, but what we want to highlight is when we look at the graph chart on the right-hand side, you can essentially see where the key gaps are in the power sector, focusing on power sector, and the climate change mitigation, transport, telecommunications, and ecosystem or biodiversity. So this is where the focus areas and the growth drivers are going to be engulfed by most investors as well as companies on this journey. Now, when we look at examples of how financial products and services can essentially drive or address the sustainable development goals, for all these 16 goals, including the 17 on partnerships, the focus areas essentially, when you look at no poverty, it's essentially driving finance through impact investing. I mentioned about microfinance for smallholders farmers can actually support the goals towards zero hunger. And when we look at healthcare investments, it does essentially drive good health and well-being. And this is where there are digitalization in terms of telemedicine, having the digitalization that will actually help the outreach for those underserved. And when we look at philanthropic donations to schools, it doesn't stop there, but it could also be enabled by digital education. And when we look at microfinance and lending to women and female entrepreneurs, that's where it would drive gender equality and keeping women and the underserved to actually have continuous career to support their family income. And then when we look at clean water and sanitation, this is where socially responsible funds can invest in water and sanitation, and this can also drive access to businesses as well for the underserved. And for affordable and clean energy, I think we mentioned about renewable energy investments and new technologies. For decent work and economic growth, there are general investments in real economy. For innovation infrastructure, it would be essentially relooking at how project finance or commercial can lend and integrate ESG criteria in their lending decisions, which we will see a huge significant ramp up in this year for the financial sector. And in terms of reducing inequalities, it's essentially to drive fair payments, not just for financial sector employees, but also to drive it, in terms of the investees or the customers that you're lending to. How do you then advocate for those policies? For sustainable cities and communities, it's also considering, how do you get the mortgage lending to provide more climate resilience enablers to actually discuss on how climate risks are being mitigated, and adaptation considerations. For responsible consumption and production is essentially driving the socially responsible investing. Climate action we'll cover in more detail, including financial ecological services that covers life below water and land, and essentially, lending to public institutions to consider for, driving peace, justice, and strong institutions. So when we look at, how sustainable finance have become urgent, to achieve the low carbon economy, essentially is also looking at, how it is already impacting, if not every aspect of the economy. So I mentioned about, the connectivity, not just on agriculture, residential, human health, labor productivity, but what essentially would be key is what are the societal issues or environmental issues that has to be tackled. So these are the key questions to ask, as part of the organization or as part of society is, should leadership on environment or social issues be an essential part of the purpose of the organization? What are your current engagement on environmental and social issues, whether it's authentic to your culture, brand, and your products? How do you play an active supporting role in transitioning to net zero? Every organization has its roles and responsibility, but how do you integrate this within the organization in the day-to-day operation? How does sustainability intersect or influence the business strategy and operating models? And how do you determine this climate change will impact your business model? Now, when we look at the type of sustainability commitments that can actually drive direction in the organization, these are the various areas that actually can be contributed by financial institutions. I won't go through it all because I mentioned it earlier, but in terms of the decarbonization commitment, I think there has been a lot of questions in terms of what does each commitment looks like. So we thought, it would be timely to actually just highlight here that there are various iterations of what a decarbonization commitment looks like. Here we see carbon neutral, carbon negative, net zero, and science-based targets. Having that different equation or iteration, whether does it cover emissions, is it being offset by removals, or it can be offset with science-based targets. So these are the 4 different iterations, and organizations need to then define which one works for them in order for them to consider what commitments are most reflective of their vision, mission, and their direction in the short, medium, and long-term future. So when we move on to the next part, after looking at the macro scenario, now let's get on to the institutionalizing, how do we then bring this into the organization, going to the granular detail. So when we look at the integrated governance and management approach towards sustainability, I would like to just keep the key focus in the next slide. Okay. So when we look at the governing body or audit committee and consideration internally and externally, when we look at the organization, typically for financial institutions, there is the essential 3 lines of defense. You have the management controls and internal control measures as a first line of defense, where they carry out the sustainability risk assessment when onboarding clients during pandemic review or existing clients. But the idea is also then apply that for environmental areas, and to also engage with clients to understand their level and business plans and to consider the uncertainties. When you look at the second line of defense, essentially is also the second part of the organization that looks at the financial controller, security, risk management, quality inspection, compliance. How did the second line of defense actually set up their own central risk frameworks, deliver the training, develop scenarios, and undertake stress testings. And these are the part where it goes to the third line of defense, where you have the internal audit as well to review the control, design, and execution. What's to highlight here is this does not stop there. There is also the external audit consideration and the regulators who will also evaluate from the external viewpoint of things. Now, when we look at how this will actually change the approach, essentially learning from what the pandemic has impacted in terms of the governance, it has it reinforced the importance of the long-term value approach to actually build resilience. And in terms of the drivers of the approach are pretty much the key stakeholders and the business leaders, where there are increased expectations, where organizations need to play a more proactive role in tackling the societal issues, including climate change and inequality. And you also see business leaders who now start to, have that conversation, how the CEOs and board are connecting and driving the sustainability performance strategy and targets. What's their role in driving, having a more purpose focus, to address the various key stakeholders' needs. So this essentially, outlines a research that was done by EY that actually highlights, to what extent the board has put in place the following practices. We can see that there is a growing, based on, long-term value maturity, there is a growing need to actually evaluate, what the strategies are in terms of improving the long-term value. And where we see the laggards are is essentially also considering, how do you that incentivize, the remuneration schemes to ensure that this long-term value are being driven internally and they're being compensated as well, aligned to actually ensure the longevity of the organization. So when we look at the framework, how to integrate the approach to address sustainability, typically it cuts across two aspects. One is on the strategy, one is on the compliance. When we look at the strategy governance, it is also to look at how do you drive that proactive, taking certain risks, looking into ventures, where the sustainable finance, where the risk and strategy and opportunities lies in, what are the transformative that the organization need to look for. When we look at the compliance side of things, essentially you have the board risk committee that actually looks at where the risks are, as well in terms of the stress testing, the financial capability, and where the portfolio would look like. So these are the two hats that typically would be institutionalized within an organization. There is a part where the more proactive pursuit and risk-taking side of the business, and there is the other part that is a more risk, management kind of approach. But essentially, this falls within the organization, essentially, and how this is being driven is to really have that two enablers within an organization rather than just have one set up. So the eventual integration to the business functions as well as rules needs to be clearly outlined to actually drive an effective integration. So when we look at breaking down even further what the enablers or sustainability change agents are, this is where we look into the setup organizational function. Where we look at, where every facet of the organizational and operational structure is affected by the ESG. And we can see that, from the high level to the board and supervisory board level, you would then need to consider now in terms of the, how the board drives sustainability strategy, performance and targets. You will also consider how the board risk committee will actually evaluate this. But you will also consider now for remuneration committee, how do they connect the performance of the board and senior management as well. So this is where the high level set infrastructure would be before it's trickled down to the next core process as well as the supporting process. The core process, essentially when we look at product management, it would be looking at the various sustainable investment. How do you consider the green and brown assets and greenwashing? Where you talk about marketing, there's also market position. Where do you communicate your performance? How do you manage the engagement with your internal and external stakeholders and the regulators as well? And in terms of the sales, is essentially to drive, what are the financial advice that you're going to give to your investees, what are, as well as to your customers, coming up with various products that actually fit their needs, and considering whether is there opportunities to drive new technologies as well in terms of sales. And in terms of processing and handling, there is, the discussion of the conflict of interest, taxonomy, what's the use of funds, and when you come to customer service, it's essentially how do you handle the grievance mechanisms, the complaints and the governance structure. So when we look at the support processes, these are essentially where other parts of the functions of the organizations is the legs, the arms, the heart that actually need to also rally together. This is where you see in terms of the laws, the regulatory affairs, the finance, the compensation incentives needs to now come together to actually see how they can actually consider the advancement or the components of ESG into how they actually operate, incentivize, provide legal advisors, handle the business operations, whether, when you look at asset management, how effective are the assets and how resilient is it, towards flood, climate risk. So these are things that needs to be considered. I will move into more detail when we talk about these aspects. When you look at integrating sustainability into procurement, what we see now is essentially the drive on improving global human rights situation, and as well as fostering the UN SDGs. So it's also considering, what are the greater responsibility to contribute to climate protection, material efficiency, what are the social standards and good governance that needs to be driven in the supply chain management, as well as, when it comes to risk mitigation, how do you ensure the security of your supply chain? How do you maintain the license to operate through management of ethics and regulatory framework? But when it comes to, what sustainable procurement really means is essentially to have clearer transparency, have a clear monitoring material sustainability risk in the value chain. And what we have seen is most organizations are starting to come out to see how they set the standards for their sub-suppliers. They would evaluate and say that, how many has been, not meeting the standards. Hence, therefore, they are being coached or they're being advised on how to enhance, the supply chain standards as well. And when we look at where the opportunities lies, essentially is to drive profit in terms of efficiency, accelerating the sustainable business solutions, to actually handle significant perception. How do you position in the market for transparency in your supply chain management? And to essentially also grow and drive the performance, attracting new talents, ensure customer satisfaction, that you are essentially the brand to come in together and be aligned with. Looking at, in terms of building facilities and management, the consideration is the need to actually plan and mitigate physical risk on your buildings and facilities. We had the flood in January, a massive flood, and a lot of operations and branches of financial institutions are impacted by flood. The question then is, how has those been factored in and considered? And when we talk about, energy, carbon, and environmental taxes, how do you consider that as well, impacting your transition risk? And in terms of smart building and energy efficiency, we're seeing quite a number of retrofit being done on buildings, and the shift to renewable energy, putting solar rooftop panels, and as well as driving a lot of energy efficiency with automation in the smart building elements of the operations. So in terms of, occupational health and safety with the COVID, there's also a need to have the awareness, well-being, and there is a discussion as well on driving mental health and well-being concerns, especially in the lockdown situation. So what building and facilities management needs to have in terms of consciousness is really to invest in green technology and assets, consider what are the ways to actually coordinate the carbon footprint and energy audits of the assets, and what are the environmental health and safety considerations in the supply chain when people visit your facilities and building management. Where the opportunities are essentially with all these automation, it can actually optimize energy, carbon, and environmental taxes. And it essentially is also to drive and reduce exposure to environmental disaster. You can actually help to actually drive renewable energy where it can be managed in a larger scale, and as well as handle the facilities for effective employee management. So when we look at integrating sustainability into human resources, what we see in terms of the drivers and trends are the digital and technological advancement in having better digital tools to enable the mix of on-site and remote working, which is quite critical in this space of in the current situation of lockdown. But with that rise up in terms of digitalization, there's also concern on cybersecurity and data privacy. There are also discussions about the issues surrounding digital inequality and social fragmentation, driven by educational disparities, unemployment, and gender and inclusion issues. So this is where it's essentially the human resources can also consider what the new climate economy would look like in terms of generating more jobs or new jobs, or how employees could then pivot to the new requirements of the low carbon and energy kind of low carbon economy kind of green jobs and green skill sets. So this transition is also to consider whether it can actually boost female participation to ensure a more inclusive employment landscape, and what are the new skill sets that comes with it. In terms of what sustainable human resource management would look like, is essentially to look at how they can evaluate how the mobility strategies are being put in place, incorporate the risks and opportunities capability building cut across the organization, promote gender inclusion and equality in workplace, encouraging voluntary and green champions within the organization, drive sustainability training as part of a fundamental onboarding training, provide adequate training educational opportunities to boost adaptive capacity and reduce the vulnerability of them losing jobs when we pivot, and more importantly is linking remuneration and promotional opportunities that comes with sustainability practices. So when we look at opportunities, it's essentially capitalizing the gains from remote working to actually boost morale, motivation, and contribute to sustainable business by having more efficiency, creating between new jobs and allowing employees to pivot. It will definitely increase the market branding or perception of the organization when you clearly drive these values and have clear ways to actually drive transparency in how you actually mobilize sustainability considerations in the organization. It will also help you to attract talents, have a diverse talent pool, and also reduce the needs of paper consumption, mobility, travel needs in that respect. So when we look at the next part in terms of the legal and compliance, what we see is, as I mentioned, a global direction to improve human rights situation. In terms of regulatory, there is increased regulation and standard setting that actually considers ESG management at the governance infrastructure, how these standards are being implemented, as well as how the communication are being done in an effective manner. How do organizations take responsibility on ESG management risks and opportunities? And it's always essentially as well to handle the greenwashing risk. And now we also hear the social washing risk as well coming up, and to also consider what are the risks of damage and litigation due to the externalities, climate change, and natural disasters. So what the sustainable legal and compliance would then look like is really to have that capability and competency to scan and understand what are the risks that affects the companies, to also drive how they can operationalize and manage the stakeholder expectation. We've seen more enhancement on having a stakeholder management strategy and policies being put in place, as well as having the knowledge of the entire legal team to be aligned to sustainability issues management, and to also regularize the internal engagement on sustainability issues. And moving on to opportunities, what we are seeing is it would help to mitigate the cost of non-compliance with any ESG laws and regulations, to also grow and improve the inclusiveness of the policies, to drive connectivity in having a diverse talent pool, intersecting with human resources, and to manage the transparency of disclosures and strong compliance with laws and regulations. Now, last but not least, in terms of marketing and branding, which is essentially quite critical for most organizations, is there are increasing negativity in terms of publicity as associated with poor ESG risk practices. There is also a consideration of whether there are greenwashing or essentially not having that transparency in, for example, the products that is being put in place or the green investments that you actually commit to. So this is essentially to also understand what the customers, regulators, investors, or all stakeholders are now looking for. What are the information that they are requesting to be put forth to public, and how the COVID-19 has accelerated the momentum to have ESG being brought up to a higher increased part of how these financial institutions are driving the force of change. And you see that in terms of the platform infrastructure that marketing and branding are using, There's also an increased online banking apps. So this will actually, need to weave in the consideration of how you actually communicate ESG management. Now, in order to look at how a sustainable marketing and branding will actually evolve, there would be a clear direction to actually enhance ESG transparency, ensure that there are specific tangible commitments and goals that aligns and connect to the products and services that are being offered. And you can essentially, the organization communicate the results and outcomes in a timely, effective manner with clear timeframes. There will also be, a significant increase on how do the organizations educate customers on the benefits of ESG products, as well as embrace the digitalization to provide the enhanced value as well. Of course, when you look at the opportunities, it would help to actually enhance your market positioning. When you offer measurable results to support your commitments, you are also able to then look at what are the various avenues of customer satisfaction that you actually can capture. And most organizations we see in the market who are leading on marketing and branding, they start to put out in place how strong do they evaluate their relationship with key stakeholders. So this is where the strength and the surveys and evaluating the stakeholder management strategy comes about, and how do you then inform that results to the public. So with that, I will pass on to Ms. Suzanne Biegel, who's the founder of Catalyst at Large Expert, to actually take us through the Gender Smart Investment chapter. And over to you, Suzanne.
Good afternoon, all. I'm so delighted to be here to speak with you today as one of the technical partners for the ASEAN LCEP, and I want to thank EY. My name is Suzanne Biegel, and I'm the co-founder of the Gender Smart Investing Summit, a global initiative to unlock gender smart capital at scale. And today I'm going to speak with you about the nexus of climate and gender finance and the urgency and importance of bringing these two things together. And I'm going to be pulling from our report, Gender and Climate Investment, a Strategy for Unlocking a Sustainable Future. Next. Let's get started by talking about the context for the growth of the field, the urgency of why it's so important to consider the nexus of gender and climate finance, and dive in. Next. You've already been speaking about climate change, climate finance, but most climate finance is not yet gender smart. Next. There's a huge demand, of course, for climate finance to facilitate and accelerate the transition to a low carbon economy and a resilient economy. And at the same time, we need to be conscious of how climate impacts different communities disproportionately. The poor are especially vulnerable to the effects of climate change, and the majority of the 1.5 billion people living on the planet under $1 a day are women. Gender-based differences in women's and men's vulnerability, as evidenced by mortality rates in extreme weather conditions caused by climate change, stem from gendered norms around mobility, skills, employment, and other factors which limit women's participation and access to resources and economic opportunities. But we must not only see women as victims of climate change. Tackling of gender inequalities can positively influence climate action. And as a study from the IMF shows, policies that improve access to educational opportunities and finance for women can lead to a reduction in not only inequality, but an increase in economic growth for the developing country. One Brookings Institution study suggests that for every additional year of schooling a girl receives, on average, her country's resilience to climate disasters increases. Why is this? Because she can make educated decisions about sustainable choices and preparedness, resiliency. For example, an educated farmer can make different crop decisions and financing and irrigation. Next slide. Finance can deliver enhanced climate and gender impacts, but beyond this, climate and gender investing is just smart investing, period. And by bringing these lenses to bear on investment decisions, we see the potential for increased returns and decreased risk. And we've articulated 5 reasons. This is not a hierarchy. We believe these are all important, but these are some of these are more relevant for others in looking at different investment actors and actions. First, integrating climate and gender investment approaches can help to uncover new investment approaches. Women innovators and entrepreneurs are creating disruptive solutions. And addressing gender in a product or service solution can unlock products and services that are more responsive to market needs. It's also about mitigating risk. Climate risks cannot be diversified away. They affect all businesses, whether directly or via customers, suppliers, and communities. And failing to address gender can be a source of market risk, operating risk, or even reputational risk. Companies or funds may fail if they brush off the gendered needs of employees or customers or suppliers or other stakeholders. And gender smart and climate smart investing provides ways of mitigating those risks. It's about meeting investor expectations. It's about driving long-term value, because a gender and climate lens can drive competitive advantage and long-term value across talent, innovation, markets, products and services, value chains, and governance. And as climate and social impact enter mainstream thinking, regulation, and policy, those who fail to adapt at risk falling behind. And finally, of course, amplifying social impact. Looking at gender equality and climate action cuts across so many other SDGs, and all development finance, and indeed all finance with the SDGs as an objective, is beginning to recognize that gender is a cross-cutting theme. So we believe that long-term, there'll be a correlation between these companies driving positive social returns and having an increased impact on financial returns. Next slide. I want to share this quote from Mark Carney, which you can read yourselves, the UN Special Envoy on Climate Action and Finance and former governor of the Bank of England. Mark Carney is an international gender champion who is pledged to champion the use of the 2X Gender and Climate Task Force tools on climate and gender, and to champion better access to climate risk training opportunities for central banks and supervisors, particularly in emerging markets and economies. Next slide. Both fields are growing fast. I don't need to tell you about the growth of the climate finance field, but I will tell you about the gender lens investing field. We estimate that by the end of 2020, there was more than $18 billion in public and private investment vehicles moving with a gender lens. And this chart illustrates the growth of those vehicles. And these two areas of climate and gender have tended to operate in silos, but the integration of the two can unlock tremendous opportunities. So we ask ourselves, what if all of the capital flowing into climate finance today had a gender lens? To build a realistic picture of the opportunity to bring these together, critical data gaps are there, we recognize that, but we have the opportunity to be carving out new solutions and examples across ASEAN. Next slide. I'd like to take a second to highlight the ASEAN region as an example of a way to bring together gender and climate. The East Asia and Pacific region is the largest provider and recipient of climate finance globally, with 250 billion USD, comprising 44% of total flows. And gender lens investing is up 160% in ASEAN, with 22 active gender lens investing vehicles across public and private markets at a total of 1.1 billion USD. In addition, annual flows of 250 billion into climate-related projects represent a huge opportunity to significantly scale up gender lens investing in the ASEAN region, although it hasn't happened yet, through ambitious gender-related KPIs being intentionally integrated across all climate finance by default. And some of the public capital providers have made some commitments in this regard, but to date, this opportunity really remains largely untapped in the ASEAN region. But it presents a significant opportunity to be a leader, both for women and for the world, and for climate outcomes that we're really looking for. We go to the next slide. I want to talk a little bit about some of the principles around applying these lenses. Next slide. So this is about bringing together a climate and gender lens together, not only in what we're investing in, but who has a seat at the table, and what kinds of companies, what kinds of funds, what kinds of ways this comes out in an infrastructure project, and where financial institutions have a role to play. There are a few different ways to think about this. One is to apply a gender lens to climate finance, existing climate finance, and to think about how do the company's products and services or value chains really impact the lives of women and girls? You can also apply a climate lens to gender finance. So thinking about where gender bonds, gender-specific investment vehicles are, and think where are the green opportunities within those opportunities. And then really thinking from the very beginning to bring gender and climate together, are there gender-specific opportunities to improve climate and business performance? And what would you look at? You would again look at leadership, you would look at governance, you look at supply chains and employment, you look at customers and communities, and you'd be thinking about where might I be spotting an opportunity by paying attention, or spotting an opportunity by spotting a risk where I'm not paying attention. And I'll get into that a little bit more. Let's go to the next slide. The key actors in this ecosystem are, of course, all of the finance providers and capital providers, from the central banks, the DFIs, foundations and family offices, the fund managers, but the intermediaries, the coalitions and networks, the consultants and advisors that are bringing these kinds of products to market, and the movement building actors. And then finally, of course, on the company side, to really be looking at businesses across ag, across energy, across transport, across manufacturing, circular economy, sustainable cities. And I'm going to talk a little bit about how this comes to light in that ecosystem. If you go to the next slide, money's already moving, and pioneer investors are leading the way here. So the DFIs, there's a set of DFIs that have collectively committed 15 billion in capital to move with a gender lens, and significantly as well with a climate lens. In 2018, they made a commitment to move 3 billion in this direction and had already moved 7 billion by the end of 2020. So this 15 billion is a new commitment. The multilateral development banks are now part of that new commitment, but they've already been acting. EBRD, European Investment Bank, IDB Invest in Latin America, the IFC, Asian Development Bank, and African Development Bank. And then funds, there are a tremendous number of funds. We're tracking more than 25 funds around the world that are already deploying climate and gender lens. And I'll talk about a few of them. And then of course, across public markets, looking both at climate and gender in an ESG context. If we go to the next slide. So you can be thinking about this from this point of view of spotting who are those entrepreneurs and innovators that either we need to be backing through venture capital, private equity, through bank finance, that could be in corporate supply chains, it could be in public sector supply chains. It might be that it's a women-owned business or women co-founded business. It might be that it's really about women in leadership. It might be about the fact that their products and services are very focused on paying attention to women customers as well as male customers. It could be really thinking about where are women in those supply chains, again, either as owning companies or as running companies or as employees in companies. So we're thinking about all of those lenses. And if we go to the next slide, and across, as I mentioned, every area of climate finance, from energy to ag to water to transport and on. So this is not just siloed in one particular area. Let me tell you about a few case studies. Agence Française de Développement, if we go to the next slide, has been working to scale up gender finance through mainstreaming gender considerations in all new sustainable bond issues. In this case, a use of proceeds bond. This would mean including requirements on gender diversity in the eligibility criteria used for the selection of projects. For sustainability linked bonds, this would imply using an additional set of key performance indicators and sustainability performance targets in the gender bond framework, along with the environmental or KPI, the environmental or social KPIs. The integration of gender considerations in the green bond framework is a novel idea. Therefore, to date, there have not been very many examples that can serve as best practices for other green bond issuers. However, there's some promising examples. Agence Française de Développement has developed a new SDG bond framework for green, social, and sustainability bond issues in October 2020. To date, AFD has only used this framework to issue an SDG bond. Therefore, instead of a green bond, this will be used as an example of how a green bond framework can integrate gender targets. Considering that AFD has been an active green bond issuer with a total insurance side of euro 3.25 billion since 2014, we might see new green bonds using this new framework later this year. And among other eligibility criteria, the bond framework requires new projects and loans to receive a neutral or positive grade in 6 sustainable development dimensions, which include gender equality alongside climate objectives. So we're thinking about access to services, control over resources and income, access to justice, combating violence against women, participation in economic, social, and political decision-making bodies, and project governance with regard to gender. If we go to the next slide, Schneider Electric, a French company focusing on energy management and automation, can use the proceeds of their sustainability-linked bond for general corporate purposes. And at the same time, it has a strong incentive to meet the SDGs that is committed to in its bond framework. If it doesn't meet its minimum KPI score threshold by 2025, there'll be a margin step up or a premium payment as outlined in the transaction document of each issue. And the KPI minimum score threshold represents on average an 85% achievement for each KPI, which corresponds to an average score of 9 or 10. This is calculated by first giving a performance score to each KPI on a 10-point scale. The equal weighted average of the scores for the 3 KPI determinants determines whether the KPI minimum score threshold has been met. And Schneider's example to show how you can integrally link a gender KPI, a climate KPI, and a training, an employment KPI is a model that you can really look at. Next slide. There's no single path to an integrated gender and climate investment approach, but the risk of waiting for the perfect opportunity or data or project outweighs the benefits of acting now, whether testing the waters with a pilot project or scaling up what it is to be done. So I hope this has given you a little bit of a flavor for how we bring gender and climate finance together, and I wish you good conversations this afternoon.
Thank you, Suzanne, and thank you also to Arina for her presentation earlier today. And that brings us to the end of our session this afternoon. I do hope you've enjoyed it. I do hope you've had some useful information. I do hope you're looking forward to and will engage in the remainder of the discussion this afternoon and over the next 2 days of the conference. With that, I'll say good afternoon and enjoy the rest of your day.
Thank you very much, Russell, Arina, and Suzanne for this session. Particularly enjoyed the practical examples and actionable items that each division of an organization can take. I enjoyed as well I think there was one slide from Arina on the differences between carbon neutral, carbon negative, net zero, and science-based targets. What is the difference between each of these commitments and the difference in scope 1, 2, and 3? For example, EY has announced its commitment to be carbon negative. There was a question from the audience around the decks. Decks will be available and the recordings will be made available after the conference, and JC3 will communicate on how to access these recordings and the slide decks. I would also like to highlight that we're currently working with Suzanne and Catalyst at Large on a piece of research on how, practical examples of gender KPIs that can be integrated into sustainable finance products. Whether you're looking to issue a green bond, a transition bond, we are currently coming up with a piece of research on what gender KPIs could be added, and we will work with JC3 and the Malaysia Sustainable Finance Initiative, MSFI, on publishing this to you. On that note, Ryan, can I ask you to turn on your video and your microphone? And I'd like all of us to welcome Ryan. Ryan Bjorkquist is the Director of Environmental and Social Risk Management at Standard Chartered Bank. Ryan brings over 13 years of experience in the financial services and banking industry. And over his career, Ryan focused on various environmental, social, sustainability-related initiatives, such as climate risk, greenhouse gas accounting, ESG risk, community reinvestments, and stakeholder engagement issues. So Ryan, you have about 50 minutes to enlighten us about how a full-fledged environmental and social risk management tool looks like at the transaction or client level, and what ENS management looks like at a portfolio level. So Ryan, over to you, please.
Great, thank you very much. Are you able to hear me loud and clear?
Loud and clear.
All right, great. Well, thank you very much for joining me today. And first, I would just like to start off and thank the organizers for having me today. So for the next 45 minutes or so, we're going to talk about environmental and social risk management at the transaction level. To outline kind of what are the key concepts for the discussion today, going to provide a brief introduction on what environmental and social risk is and how we approach it at Standard Chartered, how we apply those principles internally through our policies and frameworks, some of the key external frameworks that we leverage to then kind of further entrench those principles. And then lastly, provide a summary on some of those key ideas and concepts. So do I have access to the slides? Am I changing the slides? There we go. Okay, thank you. So like I said, what is environmental and social risk? How do we apply it here at Standard Chartered? And I think it's really important to kind of level set from the very beginning what we mean by these themes and concepts. And this is really going to build throughout the next hour or so. So when we're talking about environmental and social risk, we're talking about a few key principles. For environmental risk, we're talking about the potential harm or degradation to the natural environment. So oftentimes, I think when we're talking about environmental risk, we often think about some of those risk factors around pollution, groundwater, waste management, hazardous waste, all of those things, and those are very important. And these are the things that start to build within our framework. In addition to those, we also have these larger themes around climate change and biodiversity, which help build this foundation on the principles that feed into this. So for environmental risk and climate change specifically, we may consider things like greenhouse gas emissions, how clients operate within their own business environment, within their business activities, how they manage their emissions, how they report on them, and so on and so forth. It also includes the impacts to biodiversity. So the impacts to the local environment, the flora, the fauna, as well as the ecosystems that encompass all of these things. And so when we're looking through the lens of environmental risk, those are the things that we're looking for, not only from the client perspective, but also when we dive into the transactional side as well. So some of the key foundations, I think, to what we're going to talk about over the next hour is how do we establish a sound foundation as an institution to start dealing with these risks? So how do we deal with the environmental side? How do we deal with the social side? And then how do we put together, that sound framework to manage that not only at the client level, but the portfolio level, and then the transactional level as well. So in addition to environmental risk, the other part is the social side. So here at Standard Chartered, we define social risk as the potential to cause harm to individuals or communities. And this can be wide-ranging. So it starts with basic occupational health and safety. So when we're talking to our clients and engaging with our clients, do they have the standard policies and procedures in place to manage health and safety in the workplace, in any of those places that they operate? It expands into labor requirements. So does a company have sound labor policies to manage, and that would include things like, just standard workplace overtime, safety in the workplace. And then it goes on to, forced labor, specifically modern slavery. We do have a lot of conversations with our clients and have principles around how we manage forced labor in the workplace. And that could include everything from, child labor, and any form of involuntary workplace requirements. And so, we start with health and safety, and then it, expands well beyond that. So not only the workplace, but also larger human rights issues around affected peoples, especially when we get into the transaction conversation around projects and site-specific risks. What are the human rights implications of a development or the involvement of a project? So that includes indigenous communities, other human rights issues around cultural heritage, religious heritage, and so on. And so, I think it's really important to highlight the umbrella that is involved here when it comes to environmental and social risk. It's while some of the issues are very acute and they can be very specific, such as groundwater or labor, it is much more wide-ranging than just that. And so some of the foundation of a good environmental and social risk management program is to look at everything holistically and say, what are the risks? How do we want to manage them from a financial perspective? What do we expect of our clients? And then, what does that mean as in terms of impact to us as a financial institution? So environmental and social risk, while it's important to manage them effectively, if they're not managed appropriately, there are consequences and impacts down the line. That can involve reputational risk to the bank itself through our lending activities, as well as exposure of our clients for their business activities. So if a client is not acting responsibly, if they do not have policies or procedures in place, if they do not have those mechanisms to manage those risks, it can affect their viability as well. So these are things that I think oftentimes we think as may not impact the financial side, right? They're not really financial risks, but if they're not managed effectively, they can turn into real financial risks for the bank. It can affect a client's ability to repay their loans. It can result in stranded assets, especially on the energy side, if things are not managed effectively. So, I think it's really important to highlight the fact that these are real issues, right? I mean, so these are not things that are auxiliary or they sit on the side. They're not nice to haves. These are real issues that we do need to manage as an institution, and we need to manage as a sector as well. So a little bit of market background, and I think these are some really interesting facts that I would like to share with everybody today. The data in front of us is from one of our data providers, SigWatch, and it highlights NGO activity regarding environmental and social risk in the Asia Pacific region going back to 2018. So 2018 through Q1 of 2021, so basically today. And what we see is a steady and consistent increase in NGO activity around environmental and social risk issues. So this is an issue this is a sector, this is an area that is growing in importance. It's not going away. It's not a fad. It's not something that we're expecting to dissipate in the future. There's an ongoing importance being placed on these issues that we kind of kick the call off with. Here on this slide, it's the same data. So compared to the slide that we just showed, 2018 to 2021, and it's looking at the activity by sector. And so, I think something that is very interesting here that I do want to highlight is we do see a large emphasis being placed on the energy sector. So we have a lot of NGO activity and campaigns focused around things like climate change, fossil fuels, how the energy sector is interacting with biodiversity, for example. What are the key issues there? And that leads the rest of the sectors by a very wide margin. Interestingly enough, the second sector targeted the most is the finance industry. So it is not just our clients that are being targeted with these issues. It is not just our clients that are being burdened with the issues of environmental and social risk. It is also us as institutions that have a responsibility. We are also the ones that are being targeted. We are also the ones that are having campaigns against us for our position statements, our policies, and how we interact with these sectors on the screen. And I think that's a really important point to note because, when we're talking about a strong environmental and social risk management system, it is those policies and procedures on how we engage with these sectors, with these high impact sectors, with these sectors that have high carbon emissions or whatnot. And so I think that is a very important piece to the puzzle here, right? It's not just our clients. It's also an issue that does impact us directly as banks as well. Looking down the line, I don't think any of these other sectors would be a surprise. Agriculture, mining, fashion, forestry. These are all things that have very specific environmental and social risks associated with them. The last note on this is, I think the colors. So we have it broken out by criticism and praise. And I think it's highly skewed towards the negative. And so while we may all be doing great things, and it's fantastic that we're doing those great things, we don't get the credit for the good things, right? We always get called out for the gaps or the negative. And so I think this is something that is important to highlight here. And this is why we do need to have those sound procedures in place so we can manage those effectively. Lastly here, this is from another one of our data providers, RepRisk, which you may be involved with. This highlights the risk issues that we encounter in Southeast Asia over the same time period, so going back to 2018. And I think you can see on this chart or this table, it's a lot of the risk issues that we kicked the call off with, right? When we were talking about environmental and social risk issues. These are the same things that we see having the most risk-related incidents. So impacts on communities, landscapes, biodiversity, pollution, and down the line. And so I think we do see a common theme here that it's a real risk. It needs to be managed. It's continuing to increase. There's a lot of focus on it, and this is why we do need to have those strong policies in place. So moving on to the internal frameworks and how we approach things here at Standard Chartered. I really like this slide, and I wanted to share it with the group today because I think it does a very good job of highlighting the sustainable finance journey that a lot of us are on. And so one thing I would like to do is to challenge the group on the call today is to think about your own institution and where you fall on this timeline. If we go back to 2000, when we first kicked off at Standard Chartered around sustainability and CSR, it really was focused around that initial corporate social responsibility perspective. Employee engagement, volunteerism, reporting, right? Just making sure we have public reports, kind of everything that we consider under that CSR kind of 1.0 concept of kind of how we all kind of kick off our journey. And then moving on to today on the right side of the screen around sustainable finance and a lot of the lending opportunities that are afforded with that around green loans, sustainably linked loans, transition bonds, everything that we're talking about today. And so I would like to just challenge everybody and say, where are you? It is a journey, we're all in different places, right? And so it's really important to highlight that we're all in different spots, and that's okay. And then this is the journey that we're all on together. And that's why it's so great to have opportunities like this to kind of share our experiences, and then also kind of engage with you guys as well. I would like to just remind everybody that if you do have questions, just drop them in the chat box and we will have time at the end to go through those as well. So I do encourage you to do that. Moving on, how do we approach our sustainable finance philosophy? It is based on the Sustainable Development Goals. So we do have our sustainable finance framework, which then informs all of our opportunities and our sustainable finance strategy. Being that we're an emerging markets bank, we do feel an outsized responsibility to provide these opportunities from the sustainable development perspective. It does impact the markets that we're in. We're in 59 markets across the world. And these are the ones that are really impacted by things like climate change and all those things. So it's really important that we're focused on that. And then if we move on to the right here, sustainable finance, responsible finance, this is kind of our evolution of thinking. But I'm going to move on in terms of timing here. So how do we approach things at Standard Chartered? How do we take those basic principles that we kicked off with around environmental and social risk? How do we actually apply them internally? So we do have our overarching principles, what I like to call our overarching principles. And this really helps organize our thinking and our strategy. So we have our bank position statements, which highlight our expectations and requirements for high risk or high risk, high E&S risk sectors. Those then inform our internal frameworks. We have our external frameworks that we leverage as well. And then those then kind of feed into our procedures and how we manage things on a day-to-day. So we have annual client reviews. We review all of our clients annually for their E&S impact. We do individual transaction level assessments, which I'll talk about in a minute, and how that comes into play, and then issue level assessments as well. So if we do have a specific acute E&S related issue with a client, let's say it could be a lawsuit or some sort of issue, whether it's a human rights related issue or a climate change related issue, we also have ad hoc issue level assessments as well, which we handle on a basis like that. So what do our positions say? So we have five high level sector positions. The first is on the extractives industry. So this focuses on oils and gas and metals and mining. And this outlines our expectations of those sectors if we're going to lend to those sectors. So for example, for oil and gas, that includes our restrictions around Arctic drilling, for example, tar sands in Canada, for example, and so on. The next one is power generation. So that includes our fossil fuel requirements. A subset of that is our coal position, which I'm going to talk about on the next slide here. But this really outlines what the expectations are and how we approach environmental and social risk. Renewable energy, nuclear energy. I think another one that's important to note is our agribusiness policies. So this is where we cover our soft commodities, such as palm oil, soy, tobacco, and kind of the requirements around those for clients, as well as fisheries and forestry as well. Moving on, infrastructure and transport. We do have specific requirements around the shipping industry and the aviation industry. And then lastly, chemicals and manufacturing. In addition to the 5 sector-specific requirements, we also do have larger overarching cross-sector positions, and those are focused around climate change and human rights. And these are the 2 areas where we highlight requirements that are across the bank. So it doesn't matter who we bank, it doesn't matter what industry they're in. These are the expectations that we have as it relates to climate change and human rights. And those include things like publicly disclosing your emissions, having a plan to monitor and report on your emissions, for example. And then on the human rights side, requirements around modern slavery, forced labor, and things like that. I think it's really important to look at everything as a whole, because while we do break things out by sector, these things are all very interconnected, and they do rely on each other. We do have certain requirements that sit in one area that don't sit in another, but they all work together to really kind of create that mesh point of environmental and social risk management. And that's really what informs our day-to-day process and how we engage with our clients and how we engage with those sectors. All of this information is available publicly on our website as well if you're interested in learning more. Okay, so moving on. Here is an excerpt of our fossil fuel position, specifically on coal. So earlier this year in February, we updated our coal position, and this outlines our expectations of clients in the sector. And I think, one thing that is really important to highlight for public positions, I think one is transparency and making sure that your position is clearly conveyed to the public and everybody knows, what's expected and what the stance is of the bank. And I feel like we do a pretty good job of that here, and that's why I brought this to highlight. So we do have specific positions around coal. So for example, we will not provide financial services directly towards new coal-fired power plants in any location, any coal-fired power plant expansions, retrofits, or infrastructure in any location. So, this is something we're not in the business of anymore. We don't do this anymore. And I think, it's really important that it's clear and laid out in a way like this. We do have additional requirements for our existing portfolio because we do have an existing portfolio of coal clients. It's not something that we have just turned the faucet off, so to speak. We haven't divested directly. So we do have a kind of a tapered down process over the next few years. And that's outlined here, summarized in 2030 with any clients that are more than 5% dependent on thermal coal. That's not something that we're interested in by the end of the decade. So what does this mean in terms of environmental and social risk management? How do we actually do this on a day-to-day basis? Well, we've gone over our internal frameworks. We also have our international frameworks that we leverage. And these are also kind of specific to the financing structure or the business. But there are a few things that we leverage every day. First and foremost is the Equator Principles for project-related finance. So that includes all of our financing for project-related finance, project-related corporate loans, and all the items that are listed on the screen here. We also leverage the Ifc Performance Standards for all of our projects. That's a basic requirement that we expect of our clients and our sponsors. And those cover everything from labor and working conditions, stakeholder engagement, land acquisition, biodiversity, and indigenous people and heritage. When it comes to specific guidelines so when it comes to specific industry-specific guidelines, we also rely on the World Bank EHS guidelines. So if we're engaging with a manufacturing company, for example, or a project that might be focused on hydropower, we also rely on those as well to help kind of define what those E&S priorities should be. And then lastly is international industry practice. So we do try our best to leverage the best practices out there. That could be international certification schemes for commodities such as palm oil, the Roundtable for Sustainable Palm Oil, the RSPO, And that's really where those types of factors come in. So it's a combination of, international schemes, IFC, World Bank, and then for project-related finance, the Equator Principles as well. And that really kind of brings everything together. So when we're looking at clients and transactions, is the client acting responsibly? Do they have the policies and ability, right? It's also the ability. Do they have the actual ability to manage these issues? What are the international practices that would govern their business activities and their actions? And then, overlaying that with our internal frameworks and policies to say, this is something that we want to support, or this is something that we don't support. And that's something that we also engage with. So what are the Equator Principles? Just quickly, the Equator Principles are a risk management framework adopted by financial institutions for managing environmental and social risk. They are a minimum standard of due diligence for projects. So as I mentioned, it's a project finance framework. There are over 100 EPFIs signed on to date, over 38 countries, and they've been around since 2003. So it is a really large organization. The great thing about it is we have a lot of institutions asking the same questions. So when it comes to environmental and social risk, there are strength in numbers. We do have leverage when we're working together to really elevate that standard of environmental and social risk, and that's really one of the objectives of the Equator Principles. It is built on the IFC Performance Standards, so there are a lot of similarities between the two, and that is something that's important to note. So when we're talking about biodiversity or land acquisition, there are a lot of similarities between the IFC Performance Standards and the Equator Principles. And lastly, it was recently updated in last year, so October 2020. Full disclosure, Standard Chartered is the current chair of the Equator Principles, so we do have a responsibility there. If anybody's interested in learning more, please do reach out. I'm happy to talk to you about that and put you in touch with the right people to learn more. The IFC Performance Standards. So the IFC Performance Standards are really that bedrock for environmental and social risk management at the transaction level. And they cover a variety of things, which are highlighted on the screen here. Starting with risk management, labor, resource efficiency, community engagement, land resettlement, biodiversity, indigenous people, and cultural heritage. I think there's a few points to highlight here. The impact to communities can be varying, right? So if we're talking about a transactional level approach, there's impacts to local communities that can take a variety of forms, right? It could be displacement, it could be physical displacement of a community, right, through a project development. It could also be economic displacement. So for example, if you have a local community who has access to a piece of land for agricultural development or grazing rights or something like that, they may be displaced through economic development economic displacement. And that is something that we should also be aware of through this process. Land resettlement, biodiversity. My colleague Roger, who's going to speak after me, does have a few case studies on some of these, so I don't want to steal too much of his thunder, but we are going to dive in a bit more on some of these specific risk issues in the next session. Lastly, on indigenous people, something that is very important in social risk is the impact to project-affected communities, project-affected peoples. How are the local indigenous community impacted by a project? Could it be they're impacted through impacts to cultural heritage areas, religious areas of religious importance, and so on. And so it can be a very wide-ranging subject to dive into, and I think those are things to be aware of. It's not something that's just very straight away. So how do we actually do this? At the end of the day, we've gone through a lot of topics. How do we actually integrate this criteria into our lending decisions? I kicked off and said we do annual reviews of all of our clients. Last year we did over 18,000 reviews against our position statements for clients in these sectors. We review over 1,000 transactions annually as it relates to project-related finance. And then we do internal training as well. But we do try to manage these through these position statements. So the 5 sectors that we had mentioned before, and then climate change and human rights, and then having those sector-specific requirements that we overlay really kind of start pulling everything together. And that's our approach. So we do it through a variety of ways. So in the client level, we look at borrowing limits. We do it on an annual renewal cycle. As clients come up for renewal, we have them update a risk assessment form, which is how we approach that. And then we benchmark them against our risks and criteria that are outlined in our sectors. For the transaction level, we do it on a project or an asset basis. So if we're financing a specific project or an operating asset, we apply various procedures such as the Equator Principles to that to help manage that risk and identify that risk. It's really important to identify those risks issues early on and then move to a mitigation strategy if there needs to be one. And then if those issues cannot be mitigated, a management strategy for those gaps. And that's kind of the workflow there. Next, we benchmark these risks against our own criteria. So for example, if we have requirements around labor policies, does the client have the adequate policies and procedures in place to manage those risks, or are they not sufficient, right? So there's also an engagement approach here, a collaborative approach with our clients, where we say, these are our expectations around a policy or requirement, and how can we engage with our clients to kind of lift them up and say, this is the standard that we expect. So how can we help get to that standard? Sometimes that involves, engaging on a bilateral basis with the client and helping support them in that way. And these are really kind of some of those key principles, right? How do we kind of lift everything up to the ENS standard that we expect? We don't want to kind of just leave our clients hanging, right? We really want to support them and really educate them and understand them on what the risk issues are, why we're asking the questions, right? I mean, so it's also important to explain why we're asking or why we're interested in learning more. It's not just a simple yes or no question. There are real expectations behind some of these risk issues, and that's why we dive so deep into them. And then lastly, the issue level assessment. So if there is a media issue, if there is an NGO issue, we will engage strategically with the client on those as well, especially if they're misaligned with one of our positions, because that would be something that is very serious to us. On the right is a kind of an illustrative example of everything I just went through. So I will not go through that. But there are project-specific risks that I do want to highlight. And here are some examples and some concerns that we do have, which is why it's important that we have that strong foundational ENS management to really to manage these risks when they do happen, when these issues do happen. So, for example, if a dam collapses at a mine, which we have financed, that impacts local communities and wildlife. This is why we focus so much on the ability of a client to manage unforeseen issues. So if some of these happen, right, if there is a dam collapse, if it does impact the local community, if there is downstream effects, if it does impact fisheries, for example, that a local community depends upon, do we have the confidence that the client can manage these effectively? And that's why we ask the questions early. That's why we try to engage early, so we can have a good understanding of whether a client is capable, because that is something that does, it seems like a kind of a low priority maybe at the beginning, but when an incident like this happens, it can be a very real issue very quickly. It can turn into financial risk very quickly for the bank. It can turn into financial risk very quickly for the client as well. NGO allegations on a manufacturing site, let's say it's a fashion company or something like that. Clients' operations are halted by a regulatory authority because they don't have the permits, right? So like, let's make sure that the clients have the permits to actually operate in the area that they're operating in the industry that they're operating in, right? So also making sure that they actually have the actual permits for the industry that they're in. And then lastly, if there's maybe some sort of land acquisition or something that may impact a local community. These are all project-specific risks that we do encounter from time to time. So wrapping up here, because I do want to leave some time for questions. What are some of these key points for transaction level assessments? The first is identifying the risk issues. So going through that kind of checklist, that mental checklist that we have to say, what are the environmental issues? What are the social issues for this client, for this industry, for this market? Oftentimes on projects and transactions, that will manifest itself in the environmental and social impact assessment. That is a report that would then identify what those risks are. Can we mitigate those risk issues? That's usually done through subsequent due diligence. Now that those issues have been identified, is there something to actually do about them? Sometimes for project-related transactions, it could be, actually moving the site location of the development, maybe to lessen the impact or change some sort of the, construction of it or anything like that to help mitigate the issues or do something in that way. Manage. So now that we've identified them, now that we've tried to mitigate them, sometimes there are still gaps at the end of the day. Sometimes there are still risk issues that need to be handled in some fashion. So let's put together a management plan to do that. So let's take biodiversity, for example. We've gone through the studies, we've done the work. We know that there's a risk to a species, for example. We've taken our best efforts to put bird diverters on a transmission line, for example, to help prevent collisions. How else do we manage it? How else do we avoid it? What else do we need to do to help really kind of lessen this or really kind of lower that risk level? And then the last piece is monitoring and reporting. So do we expect our clients to provide quarterly reports or annual reports on performance? Is that, greenhouse gas reporting? Is it reporting on health and safety, on workplace injuries, for example? Do we have expectations of our clients to inform us on how they're performing? And then, that could also include things like stakeholder engagement reports with local communities and so on. There is a little bit of a delineation of responsibility, and so I think this is a helpful table here. When it comes to projects, that initial assessment is usually done by a consultant or an in-house team of the sponsor on behalf of the sponsor. So that's usually the step one. The due diligence is usually done on behalf of the lender for the lender. So it's a report made for the lender for us. And then the action plan is the responsibility of both. And then reporting and monitoring is also the responsibility of both. But I think this is kind of helpful to illustrate and kind of visualize what that workflow actually looks like and who's the responsible party. I guess that's it. So I think I would like to, I hope we still have a few minutes for questions. I know we also have a few questions in the mailbox. So
thank you so much, Ryan. You've been brilliant on timekeeping, and indeed we have 10 minutes left to take questions. We have a few from the audience, but I can invite again the audience to send additional ones. Thank you so much, Ryan. It's extremely informative on the journey of Standard Chartered and how you apply the your due diligence at the transaction level or at the client level, the internal framework or the position statements that you have taken, and how you are relying on external framework to inform that decision. That was extremely helpful and particularly close to my heart, because I used to be a project finance banker and came to the introduced Equator Principles 1 back in 2003. That's how far back it goes. But there's an interesting question on in the chat box on how far in the value chain do you conduct your environmental and social due diligence? For example, let's say you're financing a project and you're doing due diligence of a project, but do you also due diligence on the sponsor, which may have other activities? So how do you, and when the project, do you only look at the project or do you look at the supply chain? So how far do you go up or laterally on your due diligence exercise?
Yeah, it's a great question. And I think for the transactional side, for a project, the first step or the first lens is the project itself. So we will look at the policies and the policies and procedures of the project itself. So how is the project being constructed? How is it going to operate? Kind of within that first lens. We do take that next step and look at the client and say, does the client have, similarly, does the client have the governance in place to manage a project of this scale, right? Like, I mean, especially if it's a large scale project, does the client actually have the governance and the ability to manage a project of that scale? And then I think it kind of depends on the sector and the industry. So if we are dealing with, a project that's in the manufacturing sector, we will go into the supply chain and look at, say, how does this client have the ability to manage the supply chain? Do they have a responsible sourcing policy, for example? Do they have the ability to manage their suppliers? So I think it kind of depends. I mean, if it is that's one example, is a manufacturing example. If we're looking at a hydropower project, for example, I think we would look a little bit more towards the project itself to make sure that the project is managing the risks. So I think it just kind of depends a little bit based on the sector, but we will take that next level if it's necessary.
Yeah, it's a little bit like scope 1, scope 2, and 3
Yeah.
when it comes to greenhouse gas emissions. And how do you measure, or how do you assess the environmental and social risks? Do you do this internally? Have you built up a team? Do you rely on external advisors? Where do you start for an institution that would like to start looking at this? What's the right way?
So we do have an internal team. So we have an internal team that reviews our clients and our transactions. On the client side, we handle all of that internally. We have an assessment form that basically has a stoplight approach. So based on the responses from the business, it provides a rating, a high, medium, or low. And then on the transaction side, we do rely on consultants. I mean, that's part of project finance. So we do rely on input from external consultants to advise us on what those risks issues are. But we do have an in-house team that does kind of provide that check and that structure for environmental and social risks. So I think if I were to be advising someone who is just starting off, you do need to have an internal function. You do need to have someone who understands the bank's risk appetite, how those policies and procedures can be applied on a consistent basis. And then, for those larger infrastructure project finance type transactions, we do rely on those external experts as well.
And a very specific question, as far as your internal team is concerned, I mean, can you give us some details around the composition of the team, headcount, level of seniority, the level of knowledge, experience? What kind of skills are you looking for?
Sure. So I think about now we're up to 10. So we have several team members who are directors and executive directors. We lead up in through sustainable finance, then that leads up to the management team. And then we also have a couple analysts as well. So we do have a kind of a nice balance between analyst level and then kind of that director executive level as well. We also, interestingly enough, recently we hired someone who's specifically dedicated on training. So we actually have a dedicated team member focused on sustainable finance and environmental and social risk training that we can provide to our bankers, our credit officers, and everybody that is specifically focused on making sure that they have the skills that they need as well. So I think right now we're around 10. But I think the great thing about what we do is that it's a dynamic space, right? I mean, so it's always changing, it's always growing, it's always kind of a new adventure every day.
And that team looks after transactions and clients, yeah, as
Correct.
you highlighted, all these assessments that you do on a yearly basis or transactions basis. Brilliant. Can you shed some light, Ryan, on the some of the key challenges that you encountered in implementing the various assessments, and how much responsibility should the financial institution take in educating clients on the importance of considering environmental and social risks?
So I think internally, I think there are always challenges with systems and processes, right? I mean, I think that's something that we all encounter is how do we implement what we have in our minds in an actual credit system or other sort of banking system to get the information that we need. So I think systems are always a challenge, and then subsequently the information, right? So I think a challenge that we often have is making sure that we have accurate and timely information of our clients, and kind of the inputs that go into that. And so I think information is always a challenge. If you don't have the right information going in, you don't get the right decisions going out. And so I think one of those ways to help solve that is training. And that's why we have, we've made that investment on the training side, because I think, there are only 10 of us, right? And we're at a large bank. And so we can't be everywhere at every time. We can't be experts on every single client that come across our desk. So we do rely heavily on the information that's coming in. And so I think if you look at, making sure that you have the systems in place to manage the risk. And I would argue that, environmental and social risk should be treated just as highly as credit risk and other risk issues, especially nowadays. And so they should be placed at the same level as those. The information going in, so you can make the right decisions going out.
And I suppose you are frequently reviewing your frameworks or your statements by sector, right? Do you review this annually? Do you strengthen the different frameworks by sector? Do you keep track of developing international frameworks?
We do. So we review our sector position statements biannually, so every 2 years. That's our kind of standard cycle. And then if there is, if there's a large change or something very significant that has happened in the interim, we will address them more frequently. I think a good example of that is coal. I mean, we've seen a lot of changes in the fossil fuel sector, not only in the market dynamics on the business side, but also on the NGO side as well. I mean, there's been a huge emphasis placed on the relation of coal to climate change and so on. So we did recently update that out of cycle. We just did that earlier this year, but usually we address it every 2 years as kind of standard. And we do go through a process. We do look at kind of our peers. We do a peer benchmarking exercise. We look at where the international market is today, and that's kind of where those good international industry practices come in, right? If there's something new that comes out, if someone comes out with a new policy or a new framework or a new structure that is really fantastic that we support, then we would look to add that as well.
Yeah, because I mean, there's a question from the audience around, there are various ESG principles and standards. Which would you recommend is appropriate for adoption by the bank? And I think you've covered it in your presentations around the Equator Principles for project finance, the Ifc Performance Standards, palm oil standards. And I think you just mentioned, the peer benchmarking, looking at what other financial institutions are doing can probably be a good start. Is there any other standards that you would like to highlight? Any particular sector that you would like to mention?
Yeah, I mean, I think, maybe somewhere where there is a lot of movement, which might be relevant to this audience, is I think on the agriculture side. So, something we are keenly aware of is the certification schemes for those soft commodities. So we do try to stay very in touch with what's going on for palm oil, sugar, tobacco, soy, for example, and really try to see what are those opportunities to strengthen our positions. I think generally speaking on the finance side, I think we've already hit on a lot of them. The Ifc Performance Standards are really that bedrock that we look at, and then the Equator Principles for project finance. But I think we're pretty. I like to think that we're pretty open and agnostic to what those standards are. So if something comes along that is really progressive and really supports what our objectives are as a bank, we would certainly look to include that.
Thank you, Ryan. I'm torn because there's a few more questions and they keep coming fast. I'm torn between taking those questions and respecting the break because we have a long afternoon. So unfortunately, I'll bring the session to a close. Ryan, thank you so much. It's been very, very enriching for me, and I guess for the audience. You had over 350 engaged people on the line. So I would like to thank you so very much. So now we're going to get into a 15 minutes break. So I would like to invite the audience to be back at 3:45. And we will hear from our next two speakers, Standard Chartered with one of your colleagues, Ryan, and BNP Paribas. So everyone, please get your coffee, get another tea, some water, and I will restart at 3:45 in 13 minutes. Thank you. Okay, well, I hope you've enjoyed the previous session just now with Ryan, who gave us some very, very insightful comments as to how Standard Chartered is taking into account environmental and social due diligence in its lending decision. It's my pleasure to welcome Roger Charles, an executive director in the environmental and social risk management team at Standard Chartered Bank. Roger delivers technical, environmental, and social expertise to business transactions and clients to ensure that Standard Chartered only provide financial services to clients whose operations are aligned with the host country and the international standards on sustainability. And those includes, I think we've covered this in the previous session, alignment with Equator Principles, Ifc Performance Standards, and industry-specific best practices. And over the next 60 minutes, including Q&A, Roger will give us an example transaction level case study. So Roger, thanks for turning on your video, unmuting yourself. The floor is yours. You have the next 60 minutes. So you don't have to worry about the chat. I will be monitoring the questions. I might come in from time to time if a question is particularly relevant to the section you're talking through, and I will just be keeping track of time, maybe reminding you from time to time. But on that note, Roger, please go ahead.
Thank you very much, Gilles. Thank you for having me. Yeah, so my name is Roger Charles. I work in the ESRM team in Standard Chartered under Sustainable Finance. I've been with the bank 6 years, before which I spent most of my life in upstream oil and gas. And so today's presentation is really around providing some color on some case studies, transactions. And so I've handpicked a few from the last 6 years to try and demonstrate the difference in the nuances in the approach that we take to ESDD, and how easy it can be. And on the outset, I guess, you know, the key thing to remember is on the outset of a project, it might look very green and sustainable and a good and easy project. And when you scratch the surface, it can be very difficult from an environmental social perspective. And with that, even the most complex of projects could be the easiest to manage, given, and it's down to a number of key elements, which I will try and explain through this process. So I'll just crack on with the presentation. Do we have?
You should be controlling the slides.
Page down, page. There we go.
Yeah.
Oh, my slides are at the end, so apologies for going through this again. Here we go. So to really build on what my colleague Ryan has sort of given you an overview, really it's around the transaction level assessments. And for transaction level assessments, I guess, you know, the key for these is, you know, the basic principles of risk management can be applied, and this is what this slide shows. You know, the basic principles, which can be applied to pretty much any project, you know, irrespective of size, location, or sector. And many banks will already have a risk management process or framework in place, whether it be operational risk or, you know, compliance, or and so really what environmental social can do, it can build off that existing framework. And the key elements are obviously, you know, identifying what the issues are, assessing the materiality of what issues are, mitigating, you know, putting in place mitigation measures to try and bring down the risk of occurrence. And then obviously you would need to, you know, measure the residual risk, and then obviously once you go into a project, then you monitor these risks, and then periodically report on them. And in the middle of this diagram, I've tried to sort of depict what a typical life cycle of a project is, and you know, from project concept, project design, and construction and operation when we go into COD. And in an ideal world, it should look like this slide. So, you know, the banks get engaged at an early stage during the project concept. Obviously, the project hasn't started. They're just, you know, they're looking to get permissions, all the permissions, planning permissions, etc., environmental permissions, you know, all of these. And this is where we enter as a bank, and we start to review the project from the very beginning. And so if I was to go into a little bit more detail on each of these elements, then obviously, you know, at that point, in terms of identifying, what we would normally do is we would like to define what the scope of that project is. And so we'd look at, is it a project? Is it an asset? You know, what is the area of influence of that? And what I mean by area of influence is that if it's for example, a power plant, then obviously you're going to have an emission stack, and these emissions just aren't going to go directly up and straight up. They're going to go up and they're going to go down, and they're going to impact people and communities that are living around them, as well as access roads going in, or transmission lines going out, or discharges to rivers where you have other river users. So that's what I mean by the AOI, the area of influence. And then obviously then we've got associated facilities. Now these are facilities that wouldn't have been built if this project hadn't existed. So these could include pipelines, they could include transmission lines for power plants, etc., and substations. So and what impacts do these have outside of the project boundary? That's the first thing we look at. What is the extent or the scope of our assessment? And then the next thing is we would determine to undertake this assessment, what is the necessary information that we need. And we would then have draw up a scope of work to understand, depending on the project or the type or the location, what kind of, if there's biodiversity, if there is forests being cut down, do we need ecologists, biodiversity specialists, if it's going to impact upon communities, do we need community, do we need social experts involved, and to what extent do we need this? Really, the next part is as Ryan has pointed out, we have an environmental impact assessment to help identify the actual and potential environmental social risks associated with this development or project. And then finally, we have this opportunity to engage with to execute the scope of work for the ESIA. And so in many cases, in the real world, we as banks would normally get engaged after they've got approvals. Generally, a project developer or a borrower will not come to a bank unless these approvals are already in place, because it's too risky, obviously. So once we have an ESIA, then obviously for the banks, then we would look to assess this ESIA to see whether it is acceptable in terms of content and it captures all the risks. And so it goes on to the next stage, on the assess stage, where we now assess the risks and against the typical environmental performance standards. Now these could be host country laws. In the case of where Standard Chartered is a signatory to the Equator Principles, this could be the international standards for the World Bank or IFC, or we could have a combination of both, plus industry best practice. What are other industries doing around the world in terms of emissions, in terms of water conservation, etc., etc. So we would then benchmark it against these other standards. Then we would see what the risks are, and we would then look at the impact and the likelihood of this occurrence to happen, and then go on to further assess to identify whether the ESIA and the due diligence which has been done is sufficient enough to cover the scope of work which we've already identified at the very beginning. And this could mean we would need to undertake further due diligence at this point. That could be done via site visits, and that could be done through environmental and social studies, additional studies, or additional stakeholder engagements with impacted communities. And again, at this point, we would then look to engage credible consultants to undertake this work for us. As Ryan pointed out, we only have 10 of us for in the bank, and across so many segments, whether it be CIB, commercial banking, business banking, private bank, for example. So we're pretty stretched. So we would obviously use and go to credible consultants, third-party experts to help us do this due diligence in a lot of the cases. So once we've identified the risk and assessed the risk and see how material they are, then obviously we need to then put in place plans to mitigate what this risk is. And so this would normally happen prior to financial close. And so we can go into financial close with that level of comfort that the risks have either been mitigated to a certain extent or will be mitigated throughout the project. And so we would do this where, if in an ideal, as I mentioned, this is an ideal world example, as this is this is being presented, where we are engaged at a project concept or a project design phase. I mean, if we're seeing a risk that can't be mitigated, we have the opportunity to change the design, change the route of the pipeline, change the location of the plant, or just reorientate a asset in such a way that it has less impact, or add additional technology, pollution abatement technology to the project. And so this is a good opportunity to, in the ideal world. Where we've gone beyond, or you've come in too late to change the design of the project, then obviously we would need to then monitor and put in place action plans to be able to mitigate the risk going forward past financial close. And this would be done, through an environmental social action plan. By law in Malaysia, then obviously you would have ESIA, and you would have an environmental social management plan that would go with it. They would have a construction management plan, which would be implemented during construction. If it was impacting on biodiversity, a biodiversity action plan, and then a stakeholder engagement plan, and a livelihood restoration plan if they were impacting on communities, or you had involuntary resettlement of communities as a result of the project. So all of these would be developed as mitigation measures. I guess what happens after that, so you've put in all these plans and all these mitigation measures. Now the question is, to you as a bank, and this is going to be very much around the bank's appetite as well, do you consider all of these mitigants as suitable to bring down the residual risk to an acceptable level? And if it does, then great, but then if you still need to go back and have a look at it, this is a pinch point where you can actually say as a bank that the residual risk has come down, but it hasn't come down enough. Now the question is, do you want to continue to participate in the project or not at that point? And it's really a cut-off time, and that's around the financial close, prior to finance. And if you are going to accept that risk, then you need to now make sure that you have taken these plans and made sure that they are embedded within the project. And the one way that us as banks would do this would use the facility or key loan documentation to do this. So the inclusion of environmental social provisions in the key loan docs, and that would include for compliance, whether it be compliance to host country laws, whether it be compliance to the lender standards, which could be Equator Principles or IFC or World Bank, or even to best practice. And then obviously then monitoring to monitor what is the mechanism for monitoring compliance over this period, and then obviously reporting back to the lenders on a periodic basis. And then so moving on to then the monitoring. So we've got to pass financial close. Now we have a load of environmental social obligations to keep on top of during. And so we would then determine what is the frequency of monitoring. If you're in construction, we would normally want to, this is where the risks are at the most. So when you go through this whole life cycle process, the risks don't really present themselves until you've got past financial close and you've got into construction, at the point where they put a spade in the ground. So really, during that time during construction, that's where you've got the biggest risk. You've got the risk of labor issues, you've got the risk of people getting killed, you've got, there are all of these occupational health and safety, environmental risks, and also then, impacts to communities at this point, which need to be monitored. And so we would expect that during construction, you would have more frequent monitoring, and that would be either semi-annual, it could be quarterly, it could be semi-annual, in that case. And then once you get to financial, once you get to operation, get to COD, then obviously the project is up and running. And at this point, the risk profile goes right back down again. And so at that point, you might say to yourself, okay, you do have a lot of actions which are still outstanding, and we would then monitor that more on an annual basis. The other thing you need to think about when during the monitoring phase is really around who do you want to monitor. Now, do you have a client who's has a huge a big HSE team or sustainability team that can do all of this, or are they going to be going out to a third party to help them do this? And as a bank, then obviously we want to have some third party independent assurance. And so, as a mechanism within the Equator Principles, for where we categorize a project as a Cat A or Cat B, where you can have some significant risks involved that need to be managed and monitored throughout the lifetime of the project, then we would normally expect for an independent consultant, which is appointed on behalf of the lenders, to do that for us. Finally, we get to the reporting part. And again, it's around, what is the format for the lender reporting? What do you want to see? Do you want to, what are the risks that we identified and we assessed, and what are the plans that we put in place? And, what is the progress against all of these? And what is the outcome? What is the impact of that? And so really, we want to see this being reported back to us, because we put all of the work in. So I guess, through the identify, assess and mitigate part, the more effort you put into this part, the more you'll get out of the report. Finally, you've got other reporting mechanisms out there, and obviously you're going to have regulatory reporting. So in many regions that we operate in, projects would be required to report on health and safety and environmental performance to the regulator. Obviously, if you're talking with a subsidiary of a big corporate, then they would do corporate reporting up the way. And then in many cases, then a lot of companies would publicly disclose within their own annual disclosures on the progress that they're making. And what we see from the reporting part, we can help identify any other areas of concern or improvement that we implement. And then that would then go back to the mitigate part. We would assess the report. We would identify the areas of concern. We would assess the materiality of them. We would then put in additional actions within the mitigation part, and then we would monitor and report on that throughout the tenor of the loan. So that in a nutshell is the risk management sort of process for transaction assessment. Now, whether you apply these principles, on an ad hoc basis, or you embed them into your bank's broader risk management framework, whether it be across a variety of segments and sectors, there's always a few things you need to keep in mind. And so no transaction will ever be the same. They're always different. So you can do 2 or 5 wind farms or solar projects, and they're always going to be different. Always. It's never the same environment. It's never the same social setting. So when I look at this process, risk management process, you can't say, one size fits all. It's not a one size fits all approach that can be applied consistently. To make matters worse and more complicated, timing and status of the project, and when we enter as a bank, enter into the transaction also determines how you approach due diligence. So, for example, we have gone into projects where they've been halfway through construction, and so, or they're about to go into operation. And at that point, if if there was any impacts, the impacts have already occurred. And so, what do you do at that point? Is there a compensation mechanism? Is there you can't apply standards in retrospect. It just doesn't work, and it comes at a huge cost and time to the project itself. So you need to keep that approach in mind when looking at where are you on the life cycle of that project. In some cases, and in the ideal world, we would go in at the project concept, and there's a great opportunity here to, number one, appoint a credible consultant to do the work and input into their scope of work, and then also monitor the development and of the environmental impact assessments and ESDD work, where you get to review and point out if there's any gaps or holes in that work. I mean, consultants are, you know, they're great, and it's always a great third-party resource to have this expertise there. However, you know, not all consultants are the same, and you know, and you'll have the different consultants looking at the same thing but have different views. So you know, it's always, as Ryan pointed out on his earlier presentation, it's always good to have somebody within the bank to try and rationalize between different views and different perceptions to a certain risk. The good thing at project concept level, as I mentioned before, then you have a opportunity to mitigate E&S risk through project design changes. And then, you know, where you get construction operation, where you've come in during construction, then obviously your focus will be completely different. You would be looking to see whether the construction risks are being adequately mitigated and any residual risk is within, you know, an acceptable threshold within the bank's own risk acceptance thresholds. So that's an overview of the approach that we take, and then moving on, we will go on to a case study. So it's pretty simple, and as I mentioned before, even the most simple looking projects can become the most complex from an E&S perspective. So so from a road project, this was a road upgrade. So the road obviously existed. It was a 2-lane road. What made it complicated here was that we were financing the EPC contractor, who was the concessionaire, for a government-led road widening project. So the project essentially belonged to the government. It wasn't, you know, the EPC contractor wasn't the decision makers. The construction period was around 24 months. And prior to the EPC contractor coming on board, the government had led acquisition of around 250 hectares of both government and private land, spread over around 21 villages. The impact to this was like 21 religious structures and about over 400 residential, commercial, public structures, and 16 villages to be removed, involving the displacement of people. The road widening, the existing road went through 2 forest reserves, and then obviously one of these forest reserves hosted an elephant corridor straight through. So they had a lot of issues with cars colliding or trucks colliding with elephants in the past. So the challenges that we had around here was, under the law of that country, an ESIA was not required for a road widening project, and ESIA was only required for a road project which was of a certain distance. So let's just say, for example, the road project was 100. You know, you need an ESIA for a road project which is greater than 100 kilometers. You know, if your road was 99 kilometers, you wouldn't need an ESIA. So even though a project which has 100 kilometers and 99 or 50 kilometers, the E&S impacts are exactly the same. And so first and foremost, when we came into the project hadn't started. However, there was no environmental social baseline data, no information for us to make a decision on what the impacts would be, or the implications would be of us financing this. Obviously, as I mentioned before, the EPC contractor was not in control of the design or the route. The road was already existing, and all they had to do was widen it. And in terms of the design features within on that road, whether there was any mitigation measures with regards to sedimentation, runoff, with regards to you know, the elephants crossing the road, and obviously loss of access for where people had lost land. To complicate matters even further, we had COVID travel restrictions, so nobody could get to site, nobody could see what was going on. And I guess the last part, and you'll see this, and this is why I've chosen this slide and chosen this case study, is that infrastructures are considered as sustainable under our framework, which is the Sustainable Development Goals #9. And so infrastructure is sustainable in this case. However, the project was had a lot of ENS issues that needed to be managed. So obviously, we looked at what are the priority issues that we needed to address. We had biodiversity, obviously critical habitat, because we had the presence of not just elephants but other species and trees. There was the right of way for the road and for the road extension from a 2-lane to a 4-lane. And the buffer zone that went around that, and that was it was going through forest reserves, so obviously they had to cut down a large tract of cut down a lot of trees. As such, then you had there was the land acquisition and compensation, involuntary resettlement of communities. There was a loss of access, so you had along that route you had communities, and they were predominantly farming communities. Whether they were growing rubber or other local commodities, and these were more homesteads, so these weren't plantations. And so the farmers having to be moved from their areas and from their land, which wasn't all taken up by the road. They had lost access to it. So there was this. Then obviously, then we have labour and working conditions during construction. Where are the construction workers coming from? What conditions? HSE management systems, occupational health and safety management systems during making sure that no one gets killed during and they've got the right procedures and standards being applied during during the construction period. And then obviously, then there's community grievances and dust and noise during construction. So these were the priority issues for us. And I guess once we got an ESIA, so in the case of this project, we required an ESIA to be undertaken. So we went back to the client and said, we would like you to undertake an environmental social impact assessment for this project. We gave them a list of consultants, credible consultants. We helped with the scope of work for that piece of work, and we basically helped determine what these priorities issues were and focus in and really hone in on these issues. So as a result of doing the identification and assessing what the impacts were, then what came out of it was the mitigation measures. And so in terms of the road design, we couldn't obviously change the route, but where we did see locations on there where we would have had drainage issues, we would also found that the removal of trees and vegetation in certain areas would have and drainage patterns coming off the road would have led to landslides in these areas. Obviously, then the elephants and the elephant corridor, we got into this conversation around overpasses versus underpasses. Where would you rather see an elephant go, above you or below you? And so we did a piece of work with that. And going back to my first point here, the EPC contract was not in control here. This was the highway authority of this country, and so that was another part where we had to, go to the EPC contractor, come up with these recommendations, and the EPC contractor had to go back to their client and have these discussions and basically say, look, the financiers are raising these issues around elephants and the elephant corridors, and in this case, it was quite interesting that the road authority actually turned around and says, we are fully aware of these issues, and we'd like to see the recommendations that have come out in your reports. And they adopted some of these recommendations. So that was a win-win for everyone. Grievance mechanism, again, you know, it was government-led acquisition, land acquisition, so it wasn't really in the control of the EPC contractor. But all they could do, and as per the standard, was if you had a landowner or somebody that was evicted from their land as a result of this project, if they came to the EPC contractor, then there was a mechanism that was put in place to ensure that all of these grievances were directed to the correct people within the highway authority for further action. And as one of the recommendations, it was for the EPC contractor to help manage that grievance process and make sure that individuals were pointed to the right people and look to resolve these issues over a time, and not so much whether they were in control to resolve them, but to document that for the lenders as well. Then obviously we have a biodiversity management plan. There was a tree replanting program and an offset. The offset was for every one tree taken down, there was 10 trees to be replanted. Obviously, traffic management plans, construction, environmental, social management plans. I've put grievance mechanism there twice. We had independent monitoring by our consultant to ensure that the contractor was following all of the recommendations and the action plans that we had put in place, and all the provisions that we had put into the loan documentation. And so that's a pretty big list for just a simple road upgrade. So it sort of goes to demonstrate that something which can look so innocent on the outset and so easy on the outset, and something which is actually considered as a sustainable activity, the amount of ENS risk that is associated with that. So as I said, you know, a road upgrade project in another part of that country may not come up with all these issues. It may be a lot more simple. Time. Okay.
Yeah, you're doing good, Roger. We have 20 minutes left. We have a few questions coming through. So I know you have 2 case studies to left for us. So you have 20 minutes and we'll have time for Q&A.
Okay. So the second case study is utility scale renewable energy. And I haven't said one project name. This was, as you know, you don't put a solar farm in any location, or you don't put a wind farm in any location. Renewables projects such as solar and wind are generally concentrated in areas where locations which are favourable for. And so you won't just see one project starting up there, you'll see many projects starting up there. And this case study is, I guess, it goes a little bit broader than the first one. Whereas to say we looked at a number of, we had four projects. Each project was developed and financed independently of each other within a region with a high potential for solar and wind energy. The regional importance, there was a regional importance for biodiversity and migratory bird pathways, of which 2 species are critically endangered, on the verge of extinction. One of the species, 75% of that species had been wiped out in the last 30 years, and they are still dying, and they are still dying at a rate of 15% annually due to collision with high voltage power lines. And from what we know from all the studies, there's approximately 150 individuals of that bird left in there. So putting this back into a broader scale, it wasn't. We conducted due diligence as I explained in my first slide, and as per the last case study for individual projects. But the one thing that hadn't been done was hadn't looked at the environmental and social impacts at a cumulative level, at a regional level and so all of these projects could say, yes, within my boundaries and within my fence line, we're doing everything right. But then what about all of them together? They have a larger impact. And so as we went through this, again, we had the challenge of a lot of renewables projects in many different jurisdictions don't need to have an ESIA again. So again, we don't know what the environmental social baseline conditions are before the project is put in place. Again, we had government-led land acquisition and compensation. And I've put it again, renewables projects are considered sustainable. It's green. And so I think there is this misconception that anything sustainable or green as a project in terms of its definition doesn't come with any environmental social impact. But yet, and I think this is the key, is that they do. And this is the importance of having a robust environmental social risk management framework. There was changing regulations within this area, and then obviously we had COVID restrictions at this time. So the priority issues were biodiversity, critical habitat. So we identified that this area was critical habitat because of the presence of these critically endangered migratory birds. One which wasn't migratory, one was. There was the history of transmission lines and the risk of migratory bird strike and collision. The area is a water stressed region as well. There's obviously not a lot of water, and solar farms require a lot of water for cleaning, so that had to be factored in. Then there was the lack of hazardous waste management infrastructure in the area. Where were all these broken solar panels and electrical equipment and all the waste going to go? This was they didn't have the infrastructure in place. Then we had the labor influx to build this. So you had spread of communicable disease. And in the case of this one, and this and many other projects, I guess, where you do have projects where you had labor coming in, in the past it was other diseases, and today it's COVID, if you think about it in that respect. It's there was the risk of that to the local communities. Back to again the labor and working conditions, and then the supply chain, environmental and social issues associated where the equipment was being sourced from. Then you've got, okay, so these are the priority issues. So again, as before, even though an ESIA wasn't required by law, the bank needed to undertake its own due diligence. And so in order for us to do that, we required an ESIA to be conducted. We were lucky enough again to be at that project design phase where, time hadn't passed so much that we could get to financial close with having a view on what the environmental social risks are and how they could be managed. So we worked with the clients to get that done. Then we got to financial close, and in terms of the mitigation measures that we have put in place, long-term monitoring programs for threatened bird species, rainwater harvesting and robotic cleaning to conserve water was another one of the key aspects, given that it was a water-stressed region. We also had to think about two things with the cumulative impact of all of these individual projects happening in the same region. And so and this has not come around at the time of this all happening, this has come around later, where we're looking at the community. We are now looking to either commission or to work with others to undertake a cumulative impact of further planned developments in this region, given that it has critical habitat because of the threatened species there. One of the other requirements, I guess, for this threatened species is overhead transmission lines were to be buried, as opposed to, everything was to be buried. whether it be low voltage or high voltage, to reduce the impact, or well, reduce the risk of bird strike on these birds. And it was quite interesting while we were going through this process, to learn things about this species of bird, which was critically endangered, to actually understand that its eyesight wasn't very good. It's known for having pretty bad eyesight, and so that was one of the key reasons why they were colliding with high and low voltage power lines. And then I will go on to the third one. And again, I've used another, what we would consider a sustainable project, a waste to energy project. It was a 75 megawatt waste to energy project, comprised of 3 gen sets, incinerating around 4,000 tons of municipal waste per day. And there was a big need for this project because the municipal landfill in this area, in this big city, had run out of space. They had 6 months before it had run out completely. And so the need for this project was pretty great, and it was being pushed very hard by the local government. The electricity that we would generate would be put back into the national grid. So again, it's a relatively small waste to energy plant. And what needed to be done? There was definitely the need on a regional perspective or a local perspective to have the project done. But again, E&S issues, they came up, but in a slightly different way. So the host country at the time lacked regulations around waste to energy projects in terms of emissions standards. The construction had already commenced on the project, so we were late in on this, and so we had to sort of scale back and go backwards a little bit and understand what the risks were. There was a lack of data on the input waste stream and associated net calorific value of the waste going in. So, if we were to set standards, whether this plant would actually meet efficiency and emissions limits was unknown at the time. And again, as I said, this project would be considered sustainable financing under our framework. So the priority issues of this was waste input into the design and specification to meet plant efficiency and emissions limits. We did apply EU standards, design standards for incineration of waste, as well as the the World Bank and IFC guidelines for waste management and management facilities. The other thing that we found are, because we came in during construction, there were poor working conditions. Workers hadn't been paid for 4 months. They weren't getting overtime pay. There was, but they were being made to work. So late payment of wages, and there was no employment contracts. There was no grievance mechanism, so even if they did complain, it wouldn't go anywhere. On 2 occasions, on our first monitoring trip, we found underage workers on site. And then really it was about the poor HSE management on site. Just on the whole, there was people, the working conditions were pretty bad. In terms of, and then looking forward, when the plant was operational, the fly ash management, what would they be doing with all this fly ash, and what was their strategy? In terms of the mitigations we measured, as I mentioned, we applied EU design standards, which was pretty much the norm across Southeast Asia at the time. And we did a benchmarking of the waste, the input waste streams and associated net calorific values to understand, whether the plant would, meet, again, plant efficiency and emissions limits. And we benchmarked it against other projects in the region. So we got a pretty good understanding through our due diligence that even as the design was, and it was already being constructed, and there was probably very little chance for us to change the design, it gave us a sense of comfort that it would still meet the standards that we ask for. We put in for the poor working conditions and underage workers and late payment and employment contracts. From the get-go, before we even got to financial close, we put in a corrective action plan. These plans were conditional. It was a condition to financial close, and in some cases, the corrective actions went on a little bit longer, and we made them conditions to the first drawdown. And that was to really address labour issues on site. And that was engagement with the site management and the sponsors as well. Finally, knowing that, that the project as a whole could meet the emission standards, the design standards that we set. When it goes into operation, it's not so much of an issue, but like to maintain good occupational health and safety at site and to manage that properly, our key E&S action plan milestones were tagged to the disbursement schedule. So we literally had to force the client or the borrower to meet these actions in the timeline that we required to be able to draw more money down, and it works. And so that's, I guess, one of the more extreme cases of where we would be a little bit more heavy-handed and sort of hold their hand a little bit more and be a little bit more put more scrutiny on a project to ensure at the end of the day, when I look at the priority issues, we sort of looked in our crystal ball and said somebody could die on that site because of occupational health and safety. And so it was important for Standard Chartered and the other lenders who were involved that wasn't going to happen. And so we all came to that agreement to tag these action plans to the disbursement schedule. And on that point, they are my 3 case studies. So
that was brilliant,
Roger. And I will open the floor to questions.
Thank you so much, Roger. And again, brilliant timekeeping. We have 10 minutes, and there are quite a lot of questions. And I think generally I love case studies because they illustrate, in reality, beyond the theory of all these frameworks, and it actually shows what actual issues you have faced. And I love your choice because these are 3 sectors that are particularly relevant to Malaysia, whether it's road infrastructure, whether it's renewable energy project. You know that Malaysia is having a yearly auction on large-scale solar projects, and waste to energy as well. And you're a fantastic storyteller. I don't know if anybody told you that you could be a radio anchor easily with the way you play with your voice. Thank you. There's quite a lot of questions that went through the chat box. Now, the theme of this 3 days conference is finance for change, and I think your case studies illustrate perfectly how finance is able to change the way projects are being developed, the way clients are pursuing their actions. At first sight, you're having 3 sustainable projects, solar plant, a road widening, waste to energy. When you do your due diligence, so you're not simply relying, oh, this is a sustainable project, fine, let's go for it. You're actually doing your due diligence. And when you're finding issues, you didn't step aside and say, no, sorry, we can't do it. You actually drove your clients into addressing those issues. And I think, to me, this shows perfectly finance for change. You're not shying away from issues. You're laying it out on the table and finding a solution. Now, there's quite a lot of questions. People were interested to say, in the face of competition from other banks, is there a risk that your client, let's say your EPC contractor, says, well, sorry, Standard Chartered, your requirements are too onerous. Let me go and find another bank. So how do you mitigate in a context of financial institutions not all being at the same level of adoption of ESG frameworks. How do you speak to your clients? How do you convince them to bank with you and not go for another institution that may have more relaxed ESG governance?
Absolutely. It's a great question. It's a question that comes up very often.
Yeah.
And I think that if I was to look in my 6 years of being in Stan Chart, when I first joined the bank, we were engaged on syndicated transactions with other banks who we were the only Equator Principles bank. And so the client was like, well, it's Equator Principles. I don't know what that is. And then they're like, well, why are you asking me to do all this stuff? It's going to cost me a lot of money. And why should I do that? I don't need to do that. And you know what? In the early days, it was a case of raising awareness with clients. Sort of say, look, the Equator Principles is a framework. It's not, you don't need to do it, right? You don't need to implement the Equator Principles. Equator Principles is for us. It's what we need to implement. As a result, you would need to comply with Ifc Performance Standards and the EHS guidelines. And they'll be like, but they're international standards. They're international. And I'll be like, well, no, and whether it be in Vietnam or Bangladesh or Malaysia or even Sri Lanka, I mean, over these last 5 years, environmental regulations have heightened so much that in many of these regions, the local host country regulations are more stricter than the IFC. The IFC are just, as Ryan pointed out, they're just a bedrock. It's the minimum standard that we would require. But right now, if you look across all of ASEAN, their regulations are getting more stringent. And so what we say really is IFC or host country, whichever is more stringent. And I think that, first of all, there was that building that awareness up with our clients to say, look, this is how much it's going to cost, or this is the impact, and don't need to worry about all the water legislation or the air emissions legislation, because you're in your host country, you'll have to comply with host country laws. Yep, it is more stringent, for example. Whereas in this case, you would have to improve. And so I guess it was, where improvements could be made with no additional cost or change to the project, then the client was like, well, this is easy. This is great. This is, and I think it was the case of just, how do you explain that? How do you convey that message to get them comfortable to say, well, yeah, we have an Equator Principles bank in here, but really it's nothing really, it's no skin off our nose. It's not going to be too difficult to do. And then at the second point, then they walk away at the end of that project and say, we did this to Equator Principles, and then they can go back out and on the next transactions they do, they actually have a track record of saying, we developed projects in compliance to the IFC and to the Equator Principles, and they use that as a selling point when they go out to other banks, right? So it benefited both of us. However, back in that day, there were instances where Standard Chartered had to walk away because the client wasn't willing to to implement the IFC performance standards or develop the project in alignment with that, and they weren't ready for environmental and social covenants, EP related covenants within the loan documentation. To be fair, it just scared them. So fast forward from 6 years ago to now, there is over 100 EP banks, and so it's very, very rare that we ever go into a transaction where we don't have another EP bank on there, which is totally different. And a lot of our clients and a lot of the corporate clients are very aware of what EP is. Yep. So you've had project managers or you've had project sponsors that come from other companies, or whether they've done other projects and they've got international banks to finance them, and they understand exactly what is required. And so there is definitely, 6 years on, there is definitely more understanding in the market on what environmental social risks are, not only amongst our bankers but also with our sponsors as well. And I think that where, and I saw a question in there, where you see another bank that doesn't have or has lower standards, yeah, or less mature frameworks than, or than the Standard Chartered, then yeah, I mean, if we're happy to run the ESDD and carry them through the process and show them that this is what can be achieved. If we just put in that front load on these projects to make sure we've managed the risk and make it much easier in past financial flows.
And I think and I would echo the risk due diligence is something that the banks needs to complete to its level of comfort, but it's actually a risk management tool for your client as well, who equally doesn't want to be involved. Like 3 years from now, 5 years from now, if something negative happen at the project site, there's a reputation as well for the client. And I think Ryan in his earlier session mentioned that it's a reputational risk. Environmental and social is a reputational risk. So of course the bank needs to minimize it, but your client, and that's a selling point. If the client says, well, your standards are too high, let me go to another bank. First, it's a short-sighted argument, because if you fast forward 3 years, every single financial institution will have those standards in place. So the client might as well start the process now, because it cannot escape it. So you might as well start now. And even if you try and squeeze one last project because all the banks adopt the same, well, it might come back and haunt you again 3 or 5 years if something happened at the project that could have easily avoided. So it's all risk mitigation, reputational risk, minimization. That would be the argument. There was, we have just one, I mean, a lot of the questions actually cover the same point, which is how do you convince your clients to still bank with you? And I think you've hit it on the head. There's another item in the case of the road widening, because this was a concession. So you come back to the EPC contractor and you say, look, these are my requirements. How does your client go back to the government and say, well, the only way for me to get finance is to do these additional? I guess it has a cost impact on the project. Was the government receptive to?
Yeah. So in the case of the overpasses versus underpasses, they were very receptive to this. And so basically they looked at this and said, well, show us your assessment, show us your analysis of this. And so it was the case of, not in every case, you would ask your EPC contractor, use your best on a best efforts basis only, at least go and engage with the powers that be, your client, to see if you can you can change their mind, or you can improve things. And in some cases you'll get incremental improvements, in other cases you will get pretty drastic improvements, because they've just never really thought about it that way. And so, but I think it's documenting that at start, and then really, I mean, we whether it was an overpass or an underpass, I mean, it was more than that what was there before, to be honest. So at least we did have that mitigation. The mitigation measure was in place. To have a road going through a elephant corridor without having provisions for elephants to cross that road, a 4-lane highway, would then be detrimental to the bank at that point. I mean, Standard Chartered finances road through elephant habitat on the news. It doesn't look good, right, for anybody.
Roger, thank you so very much for this very engaging discussion and really live examples on how finance can be a change agent. So, Roger, on behalf of the Joint Committee on Climate Change, JC3, I'd like to thank you, and Ryan again, for Standard Chartered's involvement in the discussion. Take care.
Take care. Thank you. Bye-bye.
Bye-bye now. And I would like to invite our next speaker for today, Pierre Rousseau. If you can turn on your videos and microphone. For me to introduce Pierre to the audience. So Pierre has almost 3 decades of experience across the financial services industry, 2/3 of which has been spent in Asia Pacific. Pierre is now the strategic advisor, sustainable business at BNP Paribas. In addition to his professional life, Pierre has been actively involved in supporting projects in the circular economy, such as Nomad Plastic, or raising funds for sustainable NGOs, such as the internationally renowned Room to Read, and the Hong Kong-based and independent NGO Sunshine Action. So there's a whole spectrum of sustainable finance offerings, from bonds to lendings, to more innovative emerging offerings. Pierre will share insights on the thought process, on products and how to engage clients, share success stories, and discuss challenges of starting on this journey. Pierre, we have 45 minutes, including the Q&A. The floor is yours. I will be monitoring the Q&A, and over to you. You have control over your slides.
Thank you, Gilles.
Please go ahead.
And thank you to have me here. So talking here from a chalet in Switzerland. So I hope it will work. I'm been here for a food conferences. As you can see, everything is a good method to discuss. So what I would like maybe is to set up the presentation. If your colleagues can probably put it in so I can start to present the different slides.
The presentation is showing. You should be controlling the slide. Try.
No, I'm not. That's why. Because
do you want us to control?
Yes, please, if you can. Yeah.
All right. I think we can. So Tiffany will be controlling the slide, and on your cue.
Thank you very much. So next slide. Yeah. So first of all, what I would like to explain is that I don't think we need to make any awareness about what's going on, and the fact that you can go to the next slide, please. Yeah. And the fact that next one, please. Yeah. Next. Yeah. Yeah. So here you can see that I think everybody knows, and I don't think it's a secret anymore. With the level of awareness, every day you hear about the fact that we cannot consider nature as a free resources anymore. You know about the Earth Overshoot Day, which is a little bit longer this year. It probably be in August, but still in the middle of the year we will get a few days thanks to the COVID. I don't know if we have to applaud for that, but don't worry, the trend is not stopping, and it will go back again. Much more resources, much more needs. So I think we are in an equation which is unsolvable. So if we do not change the way we work, the way we do business, by integrating factors like climate change, biodiversity loss, and at the end inequalities into the way that we do business, I think at one stage we go against the wall. Next slide, please. And I think today it's quite clear. It's also a risk. If you are in finance, I don't know if you're in the banks, you probably have your department, your risk department, which is starting to recognize that we have no, as a financial risk, what we call natural risk, which could be climate change, which could be water, which could be soil, which could be, and that will be endless. And don't forget, this will not stop. You will have more and more and more. And as you know, as we have risk, we have also opportunities, but we need to make sure the way we measure it. Why are we sure about that? Because science tells us this. So science is proving us, it's there, it's documented. If you want to spend the time to see it, you can. If you don't believe it, read it. And if you still don't believe on science, like some people did recently, very well known, what you can do, but you can see the evidence around you. And if you look at the past 18 months, you have the best evidence ever that the nature is starting to show us that the emergency has to be treated at a hot level of business. And this brings additional things. If you look at the World Economic Forum that in Davos, what they say is that the largest risk now, which is defined, is the climate change and all the derived type of risk that you may have around that. And sometimes you may have new opportunities, and we have to be very careful, like the new opportunities may happen. Like I give you the example of the melting of the Arctic will open new routes and new business in the Arctic. Do we need to go to those new business? Is it real? We need to make sure that science validated. because new opportunities are not always done for the right purpose. And there is one thing that you need to realize today: if we take all the balance sheet of the banks worldwide, and we look at their assets in fossil fuel, we are already full. So we are completely addicted of carbon, like with drugs. We cannot get rid of carbon. And all our books today, all together, will already reach the 1.5 degrees that normally the scientists has mentioned. So we have no other choice than to de-risk our books. So that means we will have to do two things. We will have to unwind our position in our books, and we will have to reinvent the business model. We will need to reinvent business on the other side. Anyway, the cost of inaction is not a question anymore. I think if you look at what has been the few figures, is that today the impact of the climate change, it's already 0.25% in 2017 of the total GDP. In 2030, the people believe that it was 4.0%. So it means simply, if you do not change, you will pay more tomorrow than today. So this is something quite clear. So I give you an example. If today you are a steel company and you don't change your business model, you don't change your way to produce, and you are still polluting on the same way that you pollute, you will pollute in 2030 like the way you pollute today, the question is clear. You will be out of business. So that means what? It means that you need more or less 10 years to replace your factory system, your factory asset. So if you do not change today, you will be out of business in 2030. So do not expect a bank to finance you. So don't expect to have an investor to invest in your business. So this is very simple. A few years ago, where you had a good business model and you go to a credit committee or you go in front of investor and capital markets, and you are very stable, your business model didn't change and generate cash. But if we didn't take into account the externalities about your pollution, the carbon, the biodiversity loss, the inequalities that you generate, okay, you will get a very fantastic credit, or your bonds will be highly subscribed. Today, if you do not change, forget about it. You will be put on the red list of the bank, and you will be put on watch by the investor. So this is so the people who don't change are the people to put on watch. This is what the big sign they need to keep in mind. Next slide, please. So it means what? It means that today what we have to do is to accelerate into the business of a corporate the climate change, the biodiversity loss, and the inequalities. So if you are a banker and you need to look for your corporate, you need to make sure that, do my client has a strategy in order to do that? And what are the different factors that can help a corporate to do that? There are mainly 4 of them. The research and science. Research and science is needed now to back up a business model. Okay, you cannot create a business model which is not backed up by science. This is called, for the people who are a little bit familiar with that, there is what we call the SBT, which normally it's a science-based target. So it will be quite easy to follow that. There are methodology that has been put in place for that, and any corporate will have to follow that. The other factor which is changing is technology, digital, and the data. Okay, we always say that the data tell the truth. Thanks to the data now and managing more data, we will probably be able to measure what we couldn't measure in the past. And that will help to measure the truth. Sometimes we will discover that we were in a lot of perception. What we were believing was right was probably wrong. And thanks to the data, we will be able, technology will change the change, will change the speed of the change. And of course, the way to work digital will also change the way we work. So that will be a factor of change for good and for good or for bad, but at least it's a factor of change. Regulation will speed up. What is always quite important is that the business need to anticipate the regulation, but sometimes the regulation is catching up very quickly. So regulation is needed because like the taxonomy in Europe, for instance, so you will see more and more. The big danger is that if the business doesn't take care of anticipating the regulation may decide something that the business doesn't want. So it's very important to have a pretty good balance between what the business wants and the regulation to be put in place. And last but not least, what we will discuss is finance. How can finance influence the way to change? Next slide, please. One thing is clear in the finance and in the way that we will think in the future, we will have to integrate externalities in order to compute the proper profitability of your business. So it means what? It means that you need to have a business which is starting to do carbon avoidance, so you reduce your carbon footprint, but also you generate carbon capture. So that means you create this additionality to create a value. Same things, nature preservation, biodiversity preservation, but also you can do nature regeneration. I can give you example of business today, like in the engineering marine, for instance, where the people are regenerating the coral. They have a division to do that. I know another business which is not starting to create a nature engineering business where they are replanting mangrove to do the coastal protection. There are renovation of a lake by a corporate, because by renovating the lake, they will generate much more fish, and so we can increase the fish by 15 times. So you can see that new businesses can be integrated where we are taking into account nature and climate change and inequalities on the way to generate business. So why we don't do that everywhere? Because we have to change and we need to go to a transition. That's the problem. We need to come. We're not starting with a white sheet. We don't starting from scratch with a good solution. We have to transit from a bad solution to a good solution. We have to transit with a business which is generating short-term good business to a business who will be more sustainable on the long term. So for that, you need first to make sure that your corporate and the corporate you follow, the corporate you are in charge, first of all, has a vision with strong corporate values. So you need to start, is my business polluting? Is my business good? Is my business well structured? So you need to identify the new risk. You need to identify the stress. There are tools to do that, like TSFD, TNFD very soon for nature. There are plenty of methodology, but you need to do it. If your client is not doing it, forget about it. The guy will die. Systemic challenge, complexity. It's complex. So it's complex. So that means because it's complex, you will not do it alone. Your solution will be collaborative. And again, I want to stress the importance of data. Collect data, measure your impact, measure what you do. Data will be the way to get the reality and the truth, and not to be based on perception like we used to do business in the past. The transition will be uneven. Not every sector will have the same level of transition. It's easier to do a transition in energy and in automotive than probably in the agribusiness. So that means you will have the level of transition which will be uneven depending where you are and what kind of business you are doing. But one thing is for sure is that every single company will have to reallocate its capital. And the first things, the people who will be sustainable need to be first profitable. You cannot be sustainable if you are not profitable. And this is a wrong message to believe that sustainability is a cost. Sustainability is not a cost. Sustainability is just a way to do rightly business by integrating the alternative, the externalities about nature, about climate change, and about people. You will have to reallocate your capital. You will have to make sure it's in profit. You have to make sure that you will do it on purpose. Next slide, please. So this being said, this is easy, easy to say, difficult to put in place, of course. Next slide. So what is the big change that we have now is the net zero commitment. Most of the company have started now to have a net zero commitment for climate change, for carbon at least neutrality by 2050. First of all, if we look at the way finance is involved in sustainability, you can see that we have been the laggards. Nothing happened. Even people start to talk about sustainability in the 50s with some NGOs. So you can see the Nature Conservancy. it's only in PRI has been created in 26. So the investor, the long-term investor, start to realize that is important in 2006, and it's only in 2018. So that means it's only 3 years ago that the central bank and the banks have started to create their own association for sustainability. So you can see that sustainability in finance is quite new. It's not something that has been unbundled, like for the corporates, who did start in 1995 with WBCSD, for instance, or the UNEP, which has been created in 70s. So even sustainability is an issue which has been dealt over the 50 last years, has only pushed it after the COP21, and even 3 years after the COP21. So that means we have been through a process where we have been to awareness, to commitment, and now we need to enter in action. So now we are really on the decade of action. So what can finance do? Next slide, please. So first of all is to realize that the net zero is not really the game changer. Okay, everybody, countries, corporate, 25% of the Forbes index company has been already committed to it. The big company, the big investors, 1/3 of the total investment in the world, half of the countries in the world have been already committed. So this is really the commitment that everybody is doing. So that means that all the world will have to be, except China 10 years after in 2060, but all the world will have to be neutral carbon by 2050. So how we will do that, commitment. Next slide, please. First, banks have already also committed themselves to do that. So that means that it's not just that the bank themselves as an entity will have to be zero carbon. BNP is already like that, and most of the bank will be probably a net zero carbon by their own operation. But what we're talking about is about their assets. So the assets, and we're talking about 30 trillion of assets that need to be net zero carbon. So I don't know if you realize the magnitude of this is, and the way that this will acceleration, especially for identify risk, means stressed assets. So that means suddenly some assets that are financed, if you don't take them away from your balance sheet, will value zero. And so it means also that you need to reinvest that in new opportunities, new business. Okay, so it's very important. I'm insisting on those components because it's very important that this is the new normal to work. It's not just to follow your client, it's to follow your corporate and to continue to finance it on the way you do. You need to make sure that you assess their risk, and you need to make sure that your client is identifying new opportunity of business, integrating, like I mentioned before, the climate change, the biodiversity, and of course the inequalities. Next slide, please. So it means what? It means that you need to start to work on a non-linear world. We used to work on a linear business, so always growing on the same speed. Now you are in the disruptive one, or like somebody just mentioned, a circular one. So that means we are working in two types of world. The world moved from a linear type to a world which is disrupted. I'm disinvesting, I'm reinvesting. So that means what? I have a double risk. I have the risk to wrongly disinvest, and I have the risk to wrongly reinvest. So much more risk. And secondly, you have a different type of risk when you have circular economy. So that means where you are reusing some of the resources and you are creating what we call symbiosis. So that means here you have to start to create those mechanisms and those understanding at the level of the industry that you are following. Okay, reducing carbon emitting, that's the first level, but also looking at the people who are creating activities which are getting carbon capture. So that means where you create some positiveness. And I mentioned this for the carbon, but it will be also for the biodiversity, because those carbon capture and those biodiversity regeneration will be valued in your business. It will create a monetization positive. Next slide, please. So what are the things you have to take into account? It's complex. You need to have regulation in mind. You have to set up your own policies. You have to understand what are the technology moves. because if you do not understand that, you will be out of business. You need to understand the societal pressure. Sometimes you want to do business, but the society decided other way. Keep in mind that the society gives you the license to operate. So the society can put you out of business, even if you believe so. And you need also to take into account the consumer changing behavior. So whatever you're doing, you need to live in a non-static basis. You are always on the move. What are the signs that you need to identify? You need to identify the early exit site, see what your competition is doing, making sure that somebody is starting to change his business model. So today, everybody is on the move to change. So you need to realize, where do you position yourself there? You need also to look at the reputational risk and the way it materializes in your business. More and more, as I say, the people and the civil society give you. And you need to see also the appetite of investor. We have now at BNP a services where we do provide investor appetite versus the way that you people transform their business. I can tell you that some of the automotive recently, the one who are not really moving on the way to make his change from I will say a diesel power or a fuel power to an electric power will be out of business. When you are in a business, when you rely on investor to finance your factory, I think it's really important to know if when your bonds will mature, the investor will reinvest in your company. If not, you bankrupt. You just bankrupt. So this is very interesting, but it's very important that you do realize your position on this one in terms of pricing risk, but also in terms of credit risk, which will be modified very quickly. Next step. So it means that in commercial bank, you will see some business who will getting more and more important in order to finance this transition. So capital markets will be trade finance because of traceability, personal finance, because you are yourself at a personal leasing for quite important leasing for the circular economy. The carbon is important, and of course, many investment products. Okay, so you will see that there is a launch of products that will be there, and I will show you some of them, like loans, like bonds, like trade finance traceability indicator that can be exist in finance. But this is not enough. If we do not create additional solution like blended finance or de-risking funding optimization or impact product, it will not possible to finance the transition, because majority of the transition will be out of balance sheet of the client. So that means if we want all to go to the net zero and you are a corporate, you have to cover your supply chain. And if you have to cover your supply chain, you have to make sure that your supply chain is net zero carbon. It means that you cannot do it by financing this out of your balance sheet or out of your investor, because you still have to be responsible of something that normally your shareholder will not agree on. So next slide, please. So the toolbox, what we have to look. So this is really the practical toolbox that somebody who is covering or working on a corporate or somebody following a corporate need to look at. First of all, you need to make sure that you have understood the tradition, that you have a strategy, and you need to see how you want to accelerate your transition of your business model. So you need to define, what do you want to do? Are you keeping the same business model and transforming, or do you want to disrupt it completely? And the way to disrupt it is maybe to work with some fintech or to work with some startup, which will bring solution to you, which maybe to change the way you do your business. So the second thing is that you have to, as soon as you understand that, you need to align your financing to the sustainability ambition that you have. In many corporates, what we do see, that the CFO is still working in a box and the sustainability officer in the other box. So you don't see, those people sometimes don't speak to each other. So if you are a banker of those ones, make sure that the two persons are in the same room at one stage. Because you may be a bank, and as a banker, as a finance person, you normally used to talk to the CFO. But how many times do you talk to the procurement, the COO, the sustainability officer, which has been recently appointed in the company? Because all companies today have a sustainable officer. Make sure that the two are fully aligned. We have seen many cases where the ambition is on one side, but the way to the engagement to finance has not been properly aligned. The transition asset that you need, so there you have to go in detail, and there are plenty of analysis that you have to start to do depending on which sector you are. But energy efficiency and decarbonization is for every single company in the world. So everybody, every corporate has a plan to decarbonize or to go for its energy efficiency. So today, if not, you can be an initiator and you can organize. If they cannot do it themselves, they can do it with the third parties, an NGO, a non-profit, people who can help, a consultant. But today, they are definitely for every industry, for every corporate, there is a way that they decarbonize. First themselves, their own operation, their own setup, but also they have to think after that, and we will see that later on the point 5, on the supply chain. Then you need to identify partner to find a sustainable solution. I do not see one single entity today solving the problem by themselves. You can see that even the largest corporate, they work with third parties, consultants, NGOs, foundation. More and more you do see a lot of interaction there. The supply chain is important, and for the people who are cash rich, some corporates, some of them may be interested to invest in fund, to invest in assets where they can probably reduce the footprint. Okay. Then you need also to engage all your employees. Make sure that it's not just something which is covered by few people. And then compensate the residual carbon footprint. So you need to study your carbon footprint. It's a regulatory in many places now. It's a requirement by the TCFD. So if you can measure it, then after that you can manage it. And you will have to manage it because most probably your company will take the commitment to the net zero, the carbon footprint 2050. Next slide, please. So you are going, a corporate is really going to a sustainability journey. Okay, so first you have to awareness, you have to make the analysis. There are many different tools existing depending where you are, but you can be helped for that. Then you need to put this in the middle of your strategy. If your sustainability is not in the middle of the strategy, or if your client is not putting it, it's a warning. It's a big warning, danger. Storyline, you need to report. The reporting is extremely important. Us as a bank, we are doing the reporting of you all our corporate now. So whatever they know it or not, and sometimes we compare with their own. So we have put in place the own reporting of all our corporate clients, and we share that with them in order for them to understand where they stand. And sometimes we discover that we are probably being a better report than themselves. So that's a real warning for the corporate. They need to wake up call. Then ESG rating. You need to make sure that they understand the ESG. And then we have to bring a solution. Most of the time it's not a product. It will be a solution because it will be a combination. And then they need to define their own access, their own route. Everybody will have a different route. You don't need necessarily to copy paste the neighbor. Next, please. Thank you. So this is all the products that you can do. So you can see we divide it in 4 categories. The way you can adapt your business to sustainability. So it's mainly the sustainability linked loan. You will see the way that you can invest in startup to help you to grow, to modernize your setup, etc. Then after that, you have everything which is about reducing carbon footprint. So you can see we have the green sustainable bonds, you have the renewable energy financing, etc. Then we have all products that we can manufacture on source responsibly. So it's all related to the traceability. You have all the investment product, and then you have all the offset carbon product. Okay, so this is mainly what a bank is doing in terms of products. Okay, next slide, please. So this gives an example of what the BNP has done with some clients. So you can see that it's pretty becoming a business as usual to do green. So the green business is becoming the way that you deal with your clients. So I do suspect that in few years, to nominate a green or a sustainable will disappear because this will be business as normal. Okay. Next slide, please. Okay. So you can see that just having products is not enough. So that's why finance will evolve where what we call the blended finance and the impact financing. Next slide. So what it means here is that it means that we will create solution when we will use different source of capital in order to have different action. One of the action will be to de-risk, but is also to optimize sometimes to optimize the rates, the funding, and sometimes also is for scale. Just to give you an example, 70% of the projects related to climate change in emerging market out of China, so without China, are projects between 5 to 75 million. So it means what? It means projects which are non-bankable. Banks will never enter in a business which is so small. So consequently, if you do not create tools to aggregate them, we will never finance those projects. Those projects will remain on there and we will never solve the problem. So here what we do, we mix private capital with development capital, where we do create a concessional money or catalytic money or junior money in order to cover an offtake, which means an economical transaction, and to de-risk the funding. Okay, so that's really the principle. So the principle is really to bring, and the funding can become the catalytic funding can come from philanthropy and we come from public. So you are starting to blend the financing or the funding of the project, and you put in place a structure in order to make it viable economically speaking. Okay, and you provide, of course, conditions related to sustainability, which will be conditional to the funding. So that means if you have to achieve those conditions which has been set up, like if, for instance, the condition is zero deforestation, it will be zero deforestation. Okay, next slide, please. So here we did a first project that I would like to share with you, which is the TLFF, the Tropical Landscape Finance Facility. I still did that project when I was the head of global market in Asia, so it means like 2018. Next slide. So I know it very well. So what was that one is to create a group of partners when BNP, an asset manager, a research institute, and the UNEP, we put together in order to create a project bonds, which was to finance a plantation of rubber, and the conservation of half of the land was the conservation of a tropical forest. And normally the condition was sustained to the no deforestation anymore from the existing land, which has been defined at the beginning of the work. So that was the 95,000 type of transaction. And it was on a land which is equivalent in Jambi of 88,000 of hectares, so like one and a half times Singapore, more or less. And half of the land was for conservation of the tropical forest. The other one was for a higher productivity of rubber plantation. So give job for 15,000 people. Next slide, please. Okay, so what was this? What was the lesson of this transaction? First of all, it takes long time to be put in place. You have to align everybody. You cannot lead this type of transaction if you have 100 million or plus. As I mentioned to you before, majority of the project are smaller, so difficult to implement. And on top of that, there will be a lot of issues related to the way that you have to put in place the technical assistance, the way that you have to integrate in the future the smallholders. So we do realize this is very good type of products, but very difficult to replicate. Okay, next slide, please. So we came by creating fund facility. And here I give you an example of the Subnational Climate Fund, which is active now. Next slide, please. Which is covering 42 countries, where we create again an association between different players. This has been initiated by a non-profit organization. It's to 750 million. There is a junior investor, which is the Green Climate Fund. And the Green Climate Fund is protecting the capital for 20% and provide a booster of 2 or 3% for the senior investor. And we have a technical assistance where we have a due diligence, where we are measuring the impact, and where we are qualifying all the project on a nature-based solution of 28 million. So this is really the kind of example of fund that we can create in order to finance small project. Next slide, please. So you can see the way it's structured. The advantage is that the scope 3, that means the project of the company who need to decarbonize the supply chain, will be able to use the fund in order to fund that part, because they cannot use their own balance sheet or their own investor. So it's an equity fund. It will be also put in debt. As you can see, there is a tranche for grants. There is a tranche for first loss tranche, a senior tranche, and then you create a blended finance fund, which normally should attract the investor. And then you are investing in projects which are mainly in renewable energy, nature-based solution, waste and water, energy efficiency, which is all we have discussed so far. Next. And very quickly, I will give you another example. We are even going to a global fund for coral reef. So that means we are creating from conservation is an adaptation fund. Next slide. We can go to the next slide, maybe next. Because I think we're running out of time. Next. Okay, I will explain here. Yes, thank you. So here is the same things, but we are identify 26 countries where they have the 50 more resilient coral reef area. And what we want to develop is to protect those coral reefs and to build around those coral reefs sustainable activities that will preserve the coral reef. So here we have a good example of conservation can lead to business. And this is what I was explaining before. When you create positive, you can create positiveness. And all we do that because we have a grant window where we can incubate the project, make them bankable, and then when they're bankable, we can move them on the investment window. And the people can benefit from the due diligence of the funds, the technology which is shared by everybody. We can reduce the cost, and we can also cover the 26 countries as one single project by sharing the good practice, by also sharing the subsidy, by sharing also the research, by sharing a certain number of practice that can be upgraded country per country, and then after that, you can invest in projects which at the beginning seems non-bankable, and we make them bankable, and then we move them on the investment window. On this one, also Southeast Asia is highly covered because the resilience is mainly Caribbean, a big part of Africa, Southeast Asia, and South Pacific. So you have an example here when you can build tools where we can even create a business for small enterprise, because all the business you have behind that are really small enterprise who could be operated, but they will have to operate it by taking care of the conservation, and they will themselves even contribute to make sure that the conservation continue, because the conservation is the main source of their revenue. I will end up here mainly to ask questions, but that gives you a very broad perspective about how you can handle your client and the type of products that you can probably implement. You can see that if finance doesn't change, finance will never be able to fund the sustainability. You have to create not new products, but new solutions.
Pierre, thank you so much. I think we can all feel your passion all the way from Switzerland to here in Malaysia through your speech and and the examples. That was very lively, and I think you made the points very, very well, that it's not about awareness anymore. I think everyone's aware now, it's about action.
There is
financial
maybe a last
implications.
slide that you can put without I explain it, which is for me probably the most important, just before the tanks. Yeah, this is what we require in terms. So for me, it's not about doing things and products. It's about behavior. So we have to change the way we work, and we have to change the. And this is what this is explaining. And you have mainly three things that you need to take: partnership, collaboration, digital and data. You need the data, and you reallocate your capital. This is what about the transition. And the danger that you have is the greenwashing. So there will be guys who will not respect the rules. You need to make sure that you catch up. And this is what we have to pay attention to.
Yeah, absolutely. And thanks for that. I mean, the toolbox that you have shared, I'm sure will be of great interest to the audience. And all the institutional bankers in the audience. I also like in particular the example you gave on the subnational climate fund, because I think it's pretty applicable to Malaysia, where very often we hear that the large projects have no issue getting financing, but the small projects, where clients don't have the balance sheet to take them on balance sheet, but there is no non-recourse financing solutions. So those projects can't access. There's a Bermuda Triangle for those mid-sized projects that just cannot get access to financing because they are too small for investors and too big for the developers to take it on balance sheet. So I think that was a fantastic example of products that can be developed for the Malaysian market. Just checking on, well, perhaps if I can ask you the same question that we had in the previous panel, is do you feel, if a client comes to you and say, well, why should I, you're the banker, some clients may still need awareness. And I think you rightly said, well, the client will probably go bankrupt in 5, 10, or 15 years if it doesn't change its behavior. But what are the arguments that you make to a client that is not aware yet? Why does it need to change its business model?
Okay, I think today for me it's not even. I will tell you, if the guy is still asking that in 2021, when you have 10 years in order to achieve this transition, I think it's really time to wake up, to be honest, because not even you can see that not even today the protectionism of a country can save you on this. Today, all the biggest countries have already committed to this 2050, number one. So it means that it's not even today that you have to decide, yes, I can be different or can have a different business model. If you don't move, the regulation will catch up at one stage. But when the regulation is in place, sometimes it's too late for you as a business. This is, I mentioned, you need to anticipate. How can we convince them? There are different ways. First of all, we can show them where they stand, for instance, compared to their competitors. I remember I came in Malaysia 3 years ago, and I compare some of your company in Malaysia to the petrol company, to the other ones, and the people laugh at me, and by telling that I was a kind of clown. Today, those guys are catching up now. So I think that's a way to do it. Also, is to show where the competition stand, and the other things to show is to make the people think out of the short term, and to make them like a few minutes stop to think about the reports you have to do for the next 3 months, but think a little bit in terms of discount cash flow. On discount cash flow, in regards to the next 10 or 20 years, the way that your business will be. And then, if you are a good CFO, you will notice that the bill that you have to pay today will be cheaper than the bill you will have to pay tomorrow. Then after that, the rest is a political decision. You have people who are sensitive to the long term, and other people who are probably less sensitive to the long term because their mandate is probably shorter. then that's we cannot do much. You know, at the end, finance is not the one who will do the work. We are here to facilitate it. We are one of the enablers, but we are not the one changing it. So what we can do is just to help the people to think. We can show them what's going on. We can help them by making some modelization and showing them the way the balance sheet will evolve, etc. The commitment of 2050 for me is not a game changer, because now the people say, did you think about the way you will be zero net carbon in 2050, and what's the plan? So if you don't put that in your strategy, if you don't put that in the middle of your way you structure your business model, or you will do it. So you will put your company at jeopardy. But keep in mind that majority of the people who are owning the company are really going through that channel, because those people, they realize this is their own assets, and consequently they pay the right attention to it. 75% of the own entrepreneurs are people who are normally properly managing the sustainability properly. Why? Because they realize that they make the computation, and they do realize that the cost to make the mitigation today will be cheaper than the adaptation that they will have to do in the future, knowing that the adaptation in the future will be just to be out of business.
Thank you, Pierre. And I think you, as you rightly said, do not wait for the regulation. It might be too late. Many businesses are international, and you know, their own competitors might adapt quicker. So even Malaysian clients need to make the first move quickly. Pierre, do you make a difference between
Malaysia
large
has made a
corporates?
commitment on NDC to reducing its carbon, so it means that the industry which is behind will have to do it. So it's no brainer. And on the SFC, I just want to mention that normally, because the de-risking is done by the Green Climate Fund, the country need to validate the investment in the country. And if I'm not mistaken, Malaysia is not part of that today, but they can still join. So if they're interested, they need just to tell us, and let be recorded at the Green Climate Fund to have a non-objection letter, and then Malaysia will be entitled to be part of the program.
Okay. Do you make a difference, Pierre, between large corporate clients and SMEs?
On the way we think, on the way we work?
Yes. In the way you work with your clients, yeah.
Yes, definitely. First of all, because the people don't have the same level of resources. And secondly, because they probably don't have the same needs in terms of financing and support. If you have a large corporate, normally the supply chain and the way they have to transform the supply chain will be probably massive and quite critical. While for an SME is probably less problematic. The second thing is that an SME doesn't get the same level of financing, and the structure is probably sometimes much more on a combination of equity and debt, even private debt. While for the corporate, you will probably much more on the debt side, and the balance and the need on equity is probably not necessarily the one. The way to manage cash also, traceability, it's different. So you need to have definitely to have a different approach when you have a corporate than you have an SME. Yeah.
Pierre, on that note, I'd like to thank you very, very much. I'm sorry, there were just a few more questions from the audience, and apologies to those who asked that we can't cover them, just trying to keep track of time. But Pierre, thank you so much. Your example, your passion, the toolbox you shared.
Thank you for your time.
Thank you, Pierre. Take care.
I appreciate it. Thank you. Thank you.
Bye-bye now, Pierre.
Bye-bye.
Okay. I mean, I think we've had a fantastic afternoon. I've really enjoyed the sessions and the different angles to, you know, what institutional banking can start taking into account climate risk and how it can, effect change in the way the corporate clients behave. So I'll bring the afternoon to a close. If Sancho, can you launch the polling? So if you don't mind, please answer the 3 questions quickly. Was the event effective in increasing your understanding? Which sessions did you find the most useful, and what topic would you like to learn more about? That helps us in the design of future events. Very, very important, please. So I think we had diverse sessions hearing from Standard Chartered on how do they approach climate risk management, environmental and social due diligence at a transaction level, at a client level, sharing examples of their internal procedures, and I think that can inform a lot of the financial institutions on the audience on how they can set up their own internal team and procedures. They've shared, Roger from Standard Chartered shared some very lively example of how simple renewable or sustainable projects on the face of it have difficulties that need to be looked into through due diligence, and how the proper internal framework can effect change in the way those projects are developed. So I thought it was very, very useful examples on finance for change. And lastly, Pierre was very passionate. We are past the awareness level. We are now into action, and equipped us with some insights on how we can advise our clients as financial institutions. We can effect change in a very wise words that we should not wait for regulation, because otherwise climate risk is going to catch up with customers very quickly. So I'd like to wrap up this session now. Thanks for staying with us and for your active participation throughout the day. There's a very interesting agenda for tomorrow on sustainable finance, the management of climate change. We'll be discussing Bank Negara's green taxonomy, giving tips on operationalizing the TCFDs, providing insights on climate risk disclosures, and more. We'll hear from the Ministry of Environment and Water on the national agenda, the Minister of Finance on sustainability in public finance. So I'm wishing you all a good evening ahead, and meet you tomorrow. Take care, everyone. Bye-bye for now.